All right, guys. Today we got the Fed meeting. The first rate cut in 4 years happens in about an hour, maybe a little bit more than an hour. So again, this is the first rate cut. Just to put it in perspective, in 4 years, the last time the Federal Reserve cut interest rates was early 2020. Right when everything crazy was happening back then. That's the last time the Federal Reserve cut interest rates. And today will be the first time they're cutting rates in 4 years. The big speculation is how will it affect the entire stock market? You know, how will it affect Nvidia? How will it affect everything, really? And again, I don't know. I don't know what's going to happen. I don't know how it's going to affect things. You know, we can only hope good action, but that's not always the case, of course, with these Fed decisions. Hey, thank you, guys. Yeah, again, this is our first rate decision in a minute, man. So prepare yourself. All right, guys. So let me get the scroller up. You should be able to hear the music. Let me know if you can't for whatever reason, but you should be able to. There we go. We'll put all the other stuff up too. Let me exit out of some of these, man. We got next week we got GDP and PCE data coming out too. But this is a massive report. This is the first Fed rate decision that's going to be a cut in 4 years. Expectations are overwhelmingly for a cut. And so, yeah, we're going to cut rates today. Almost certainly. Nothing's ever 100%. We'll put that up. Yeah, it's the biggest report of the year so far for sure. It's the first time the Fed's is doing cuts, right? And so we're going to get a poll out here right now. How much will the Fed cut today? First one is going to be 25 BP. Second is going to be 50 BP. Third one is going to be no cut. Fourth is going to be something else. Or we'll do another pause. And then you can just comment that out. There you go. It's the biggest report of the year, chat. Yeah, I type about 100 words per minute, maybe. Yeah, on a good day, right? Like on a bad day, some days are just not good, but on a good day, 100 words, maybe. I think the best I've ever done was like 105. Too bad typing in itself is an obsolete skill, you know? Open up my stevia cola, my sugar-free soda. Yeah, so let's go ahead and take a look at what's expected in an hour and 2 minutes. Right now, we're almost completely split. We're 55-45 right now. 50 to 25 basis point cut. Yeah, and this is by CME Group, Fed Watch Tool. 100% chance of a cut in terms of probabilities. No chance of a pause. No chance of a hike. Next meeting, they're expecting us to be at 450.75. But these are still a little skewed because we don't know how much we're going to cut today. 55-45, we're pretty much 50-50 split, which is interesting. It's interesting for a number of different reasons. The main reason being that obviously it's kind of polarized back and forth. And so the amount of volatility that we get from this rate decision today might be high. It might be high. Again, I don't know what's going to happen. Right now, 50 is what's expected, but this could change back and forth. I think it's 50. The senators did an open letter asking for 75 to make it seem easier and less scary for 50. Possible. Yeah, it's possible that it's 50. I don't necessarily agree with 50. I think 25 would have been better. But who knows? I've gotten every Fed decision right for a year straight, but this is one that I'm honestly not super confident in. I don't know what we're going to get here today. I really don't. I don't know not only do I not know what rate decision we're going to get, because it's almost 50-50 split, I also don't know the reaction the market's going to give us from this. This is an interesting meeting. It's genuinely super interesting. Again, we don't really know what's going to happen. And that's why it's interesting, leading into this report. So, yeah, we'll see. 25 in the market pumps. I don't know, man. I think it's super interesting to look at. I don't know. Again, this is one of those meetings. Sometimes I'm confident, sometimes I'm not in the actual outcome. Again, this is one of those meetings. I'm just not super confident in the outcome here. John, I think the next 3 cuts will all be 25 and the market will rip and bubble out before elections. Possibly, Again, I think that's best case scenario. I would much prefer us to do 25, 25, 25 than 50, 25, 25, you got to think, this is in basis points, so this is quarters of a percent. So 25 basis points is a quarter of a percent, 50 basis points is 0.5%, 75 basis points is 0.75%, right? And the Federal Reserve is going to influence rates to control the economy, whether it's good or bad. If inflation's a problem, they're going to keep a hawkish, high interest rate environment. If the economy is bad, just to simplify it, they're going to maintain a low interest rate environment, what's called a dovish stance, because when money's cheaper, basically when there's less interest, when people can get loans easier and cheaper regarding interest, they tend to spend more because they got cheaper access to money, right? And this has implications to real estate. It has implications to the stock market. It has implications to bonds, especially bonds, over a lot of other things. And obviously, it has implications to mortgages and real estate in that regard. Now, you got a couple potential outcomes from this, what I'm going to call a dovish Fed, because this is a dovish Fed. A cutting Fed is a dovish Fed, right? You got a couple potential outcomes. One of them is, people have been talking about real estate and why we're going to enter a recession or depression, but one of the consequences from rate cuts in this regard, and especially aggressive rate cuts, like if today's 50 basis points, is going to be lower mortgage interest rates over time. It's going to have a year plus lag, so it takes time to affect everything else. It takes time for short-term rates like the federal funds rate, which is what they're influencing and changing today. It takes time for that to trickle into longer-term loans like mortgages and auto loans, right? So one of the outcomes could be prices actually go up more in real estate, and automobile, or you could say, hey, well, it's going to unlock competition in real estate and cars, and maybe prices are going to go down some. Either way, I think it's plausible. And so we'll see. It's also possible that, if we continue to dump rates throughout the rest of this year, that next summer, when the real estate market starts to heat up residential wise, that it turns into a big bull market in residential buying. That's possible too, because right now it's kind of stagnating. Specifically, what I mean is residential real estate is stagnating right now. So that's a theory as well. We could put a lot of theses out there and guess what's going to happen. But what we're really looking at today is short-term effects of these rate cuts in the stock market. Nvidia down to 115, so the SPY right around lifetime highs. So the SPY, the stock market itself, the Nasdaq, the Dow, all pretty close to lifetime highs. The SPY's probably the closest. The Nasdaq lifetime highs are way back here at 503, so it's still got a little ways, but we're still pretty close to lifetime highs. If we look at the Dow Jones, the Dow Jones recently broke lifetime highs today. Or no, maybe this might not the Dow Jones broke lifetime highs today. So it's interesting. How these rate cuts are going to affect broad markets. We'll wait and see. And that's why it's such a big report today. That's why we start the stream up. This will probably be one of the biggest events of the year in terms of finance. We got 500 people here already. We started up 8 minutes ago, 7 minutes ago. Well, commercial's a different animal though, Sass. I mean, it's obviously going to influence commercial as well, but commercial has Commercial's a struggle. Anyway, it's risky to bet on commercial right now, depending on the sector. There's different sectors of commercial real estate. Some of them are incredibly risky right now. Which ones do I mean? Warehouses, super risky. Big building commercial, super risky. Why? Because people don't need, technology has evolved. People do not need to put a bunch of people in warehouses anymore with remote work and conferencing software. And so that's been impacting commercial. If we look at a commercial graph, here's as of like October, here's a 10-year chart. Commercial prices have really been struggling, dude. If you want to see, like, this is since 2006. Now this is the percentage change 2020 with the low interest rate environment. Here's the low interest rate environment at 2020. As you can see, commercial did appreciate the following quarters all the way into late 21, and then it started decreasing in 2022, bumped up in second quarter 2023, decreased. Let me see if I can get just an average property price for commercial graph somewhere. It's only going back to 05. Okay, here we go. Yeah, so here's a very good look at it. All right, so this is from 2014 to 2023 regarding commercial real estate prices. This is from Statista right here. All right, so this is commercial property prices over the last 10 years. One of the issues that you're seeing here in commercial, and again, it's exactly what I said, which is that it's stagnation, right? Like, look at this stagnation here. So that's the most stagnation we've seen in at least 10 years. Generally speaking, property values rise. One of the reasons is because inflation rises over time. But commercial properties are now going sideways instead of up. And they've been going sideways since 2020 for the last 4 years straight. Haven't really gone up much. Basically going sideways. Now, again, why? Why is this? After 2020, in the pandemic, everybody started working from home, right? And so places in which used to be packed full of employees no longer are needed because they're using conferencing software now. And you can see it reflected in price. Supply and demand has stagnated for commercial. It's a riskier investment. Let's just be honest here. It's a riskier investment. Now, residential real estate's still fine, of course. People are always going to need to buy real estate residentially, but risky investment in that way. What do you fear the Fed will do? What am I worried the Fed will do? I'm worried they're going to cut 50 basis points or more today, and that is going to make inflation spike. I'm also worried they're going to pivot to a quantitative tightening or a QE stance where they start wanting to expand their balance sheet again, and that's going to make inflation worse. To put it into perspective, I talk about this every day, but we got different viewers here. QE is a form of money printing in which the Federal Reserve creates bank reserves and then uses those bank reserves to buy financial assets, mostly bonds, and that injects liquidity into markets, but it causes inflation as well, certainly causes inflation. And that mixed with a low interest rate environment already with rate cuts can cause inflation to spike more. And I think we've had a lot of inflation in a 5-year period of time. We don't need more. And so while I know people are pushing for rate cuts because they might want to buy property, and it's tough to buy property right now, and to go to the other side of that, to try to be objective, cutting rates should benefit buyers, right? Right now we're in a period of time in which the conventional appeal of real estate isn't there in terms of mortgaging a property. Interest rates are high relative to the last 20 years. They're actually right around the 40-year average, 50-year average. But over the last 20 years, we're pretty high versus where we were prior to 2020, right? Prior to 2020, we were at like 2.5%. Even 2020, we were at 2.5%. The Federal Reserve cut rates to try to save us from a recession and depression of 2020. And so they cut interest rates, did QE, printed money. And the consequence was rates went down, and people were more able to get mortgages, and all that's good and fine. But inflation spiked. And so with inflation, expenses, and with expenses, rent prices. And so if you want to know kind of how all this came to be, that's what happened, right? With inflation, expenses raised, and as expenses went up, rent went up, basically. So low interest rate environment is good sometimes, but it can also be a bad thing for the economy as well. And not in terms of like basic economic stimulus. It's always a good thing for economic stimulus to stimulate the economy. And, if you want to increase buying, it's great. But if you want to control inflation and stabilize pricing universally in the country, interest rates being low can be a negative as well. I mean, again, I'm okay with us cutting rates. I just hope it's not too aggressive too quickly to where we spike inflation. That's what I want. Oh, let me get a countdown timer. I got you guys. Hold on. Whew, this is a massive event in stocks. A massive event. We got 49 minutes. Don't buy now. House prices will lose 50% of their value. I mean, even if they do, right? The thing you have to understand about rental properties, right? Like, I'm buying as a rental property. I'm certainly not mortgaging it. And so I'm in the middle of a house purchase right now. But it is a rental property. And again, I'll give you the math for it, right? Regardless of whether we lose 50%. All right. So, number one, let's say we get a $300,000 rental property. Let's say we could charge $2,500 a month on that rental property, right? So we're gonna make about $2,500 a month times 12. It's about $30K. Let's take 40% of that off, which is pretty conservative, right? 40% gone, insurance, expenses, taxes. 40% is wiped out basically. So 0.6, about $20K, $18,000 in cash flow just in this alone, right? Over a 10-year period. I'm gonna make $216K. So that's pretty good, right? And that doesn't include if house prices do go up, which is the normal state of housing. Even if we do have a recession or depression, it's eventually going to correct over time as well. Over a 10-year period, we're going to be where we were anyway, even if we go down. If you look at, like, let me see. Let me find this. Okay, so here's a good example. All right, here's the mania of the pre-2008 real estate market prior to the mortgage disaster. Okay, and it took some time, right? Here's the mania top. This is the Case-Shiller. Okay, Case-Shiller house price index had the average house 184K in 2006. 184K. This is at the tippy top of this data. By 2015, so within 10 years, we were right back to where we were. We were basically even. Okay, and so when you add cash flow to it in terms of rental property, you're still profiting from it over a 10-year period of time, right? So again, I could worry about recessions, depressions. Time heals a lot of wounds in that regard. And the other aspect of it is that, like, yeah, I can get $2,500 right now. In 10 years, I'm going to be able to get more than that because the home price should increase. And even if it doesn't, the cash flow will pay for it. So either way, it's still a good deal for me. How long you been doing stock? I don't know. John, inflation's still going up. This cut will be a panic cut for the labor market. Sure. Here, let me get the countdown. There's the countdown on the top left if you can see it. And again, I don't know what's going to happen. Yeah, I saw it, Sam. I'll have to look at it a little bit later, brother. It's just kind of a busy time for me, bro. I doubt they'll do QE. Cutting plus QE would be too aggressive at a time when Jerome Powell knows this is... Yeah, 100% agree. Too optimistic in terms of what? What age were you became interested in economics? I don't know. U.S. government alone printed $2 trillion during... Yeah. Well, yeah, you saw prices rise for everything. Rolex prices doubled. Bernard Arnault, one of the richest dudes in the world now. He's the owner of Louis Vuitton, Hennessy, a bunch of big brands that you know. He owns them all, and prices appreciated everywhere for that. So Is there a chance 25 basis points is not enough stocks to skyrocket? I don't know. I hope it's 25 basis points. It's not 50. We're cutting rates. It's bad. There's zero chance we're not cutting rates today. It might not be zero, but it might be 0.1% chance. I would give it maybe like a 0.5% chance that we don't cut rates today. But again, if we don't, right? If it turns out that we don't cut rates today, I don't think we're going to have a good reaction to it. I think that's going to cause people to freak out too. So either way, I don't think it's necessarily good. I think the best case scenario for markets is 25 cut today. And again, I might be wrong about this too. I really don't know, right? Like, I think the best case scenario is 25 cuts or 25 BP cuts, because at least in that situation, like, it's as expected, and it's conservative in that regard, you know. Rate cut without a recession equals stock market skyrocket. Better load before 2 p.m. Maybe. I hope so, you know. And then the other good thing about the house I'm purchasing, okay, so I'm not going to be too specific just because people are weird on the internet. But I am getting it for about 20% under list. So I'm getting it for a discount regardless. And so even if prices do correct, I got a 20% bubble that I'm okay with, you know. And so either way, I'm okay with it. I don't think the economy is ready for a cut. In what regard? AID, or whatever your name is. There's a timer. There's a big old timer over here. Just a weatherman this for you. Hold on. Hold on, wait. There we go. All right, look. Just look right there. There's a big old timer right here. It's probably better for me to be up here anyway. Hold on. There we go. All right, so this is NVIDIA on the left side anyway. Here, I'll put the thing up. Top 3 drawers in the world right now. But yeah, there's NVIDIA. Here's the Dow. And then this is gold. Yeah, the last time I checked the Fed Watch tool, it was... But I guess the overarching point is that long-term in real estate, here's the Case-Shiller House Price Index for the last 40 years. It's a lot of gains. You know, rent over this, like over a long-term period of time will increase. Like for me, it's an investment property, you know, so like it's a nest egg anyway, you know, so regardless of what happens over the next 10 years, I'm going to earn cash flow from it. And as long as I don't sell, it doesn't freaking matter, you know. So I hope all that makes sense. It's Bob Ross. Where's Bob Ross? Hey, so just the only problem speaking a different language is if it clouds up the chat, you know, I'm going to have to discourage it. So respectfully, you know, it's hard to tell whether it's bots or not as well. So, and again, commercial, been on a struggle. Let's see. So this is for the last 4 years straight. Commercial hasn't gone anywhere in terms of price. It's been stagnating. I want to buy a rental property myself, but houses in New York, you can't find anything under 500K. Honestly, bro, let me be completely honest with you. You do not want a rental property in New York. Okay, the landlord laws there are crazy. Like if you leave your house for 30 days or longer, even if it's your property, you got the deed to it, people can just move in, bro. They could change the locks. It's their house now. You know, it's like the guy on the pirate movie. That's their house now. You know, the laws are genuinely crazy there regarding landlord. I would never buy rental properties there. It's just too risky, you know, especially if I don't live there to be able to control it and you know, monitor it. I'm good there, dude. That's, you know, Although at the same time, to give you some positive things, I'm sure the real estate market there probably has a lot of appreciation over time as well. So there might be some arguments for it. I think you would just have to be there to monitor it. Yeah, I feel you. I get it. No matter what Powell says, cycle is at top now. Forecast drop 926. Maybe. How'd you manage 20% off? Well, I don't want to be too specific, but we had, quick close cash. Quick close, we get it from that's why I wanted to do this, is because, in a year when interest rates start going down, it might not be as powerful to be able to do that, but right now, stagnation, not a lot of people have want to get a mortgage, and so properties are sitting for long periods of time. I can throw low ball offers out, hopefully get them accepted, and that's what ended up happening. Anyways, Dow Jones broke lifetime highs. Was it today? It must have been yesterday. Hold on, let me see. That was a monthly chart. Dow Jones broke lifetime highs yesterday, not today. Sorry, yesterday, just to clarify. And then I'll put the SPY up instead here. Let me find my little eraser. All right, here's the SPY. SPY is slightly green on the day. I thought we'd get choppiness. Yeah, top 3 negotiators on the planet. Hey, nice, Daphne. That's great. Yeah. What are you about the dollar, oil, and bond prices crashing together now? Well, the dollar, the dollar prices are going to go down as inflation gets combated, right? So the Dixie's supposed to drop. And the problem is, we're at the bottom of a range, but the dollar index, when the dollar index was spiking up in 2022, everybody freaked out. They're like, oh, the dollar's spiking up. It's the end of the world. Inflation. And then when the Fed pivots to a hawkish stance with quantitative tightening, high interest rates, and the dollar starts to correct down, then people play the other side and they say, oh no, it's the end of the world. The dollar's crashing, guys. Either way, it's not the end of the world. The dollar goes up, the dollar goes down, depending on what stance the Fed has and what they fear at any given moment, whether it's inflation or whether it's economic weaknesses like a recession or depression or whatever. So the dollar's going to be going down right now. The Fed's been doing quantitative tightening. Bond prices, they're a little bit more nuanced, but yeah. Don't you think inflation is too sticky for the Fed to cut rates? Plus, it seems, it's an election year, right? So what happens during election years? Well, during election years, hold on. So during election years, they have a lot of pressure. Why do they have pressure? Because whichever side's in power, and it's not specific to any given side, it's both of them, really. Whichever side's in power, they want a strong economy. So they want economic stimulation because they want to say, look what we have done. Look how great the economy is. And the other side is kind of the opposite where, but yeah. So when interest rates go down, they move inversely to interest rates. Bond prices, specifically, the price of the bonds. Not the yields, but the prices of bonds move inversely to interest rates. Meaning when interest rates go down, bond prices go up and the yields go down because there's more bonds available, so the yield decreases. So one of the things that's probably going to happen is that bond yields are already starting to correct, and they have been. And this is where the yield curve inversion, you can kind of see it in shorter term bonds. But, if you look at bond yields, right, these were 5%. These were 5. This was at, you can move a percentage point over to see what the actual percentage is. But yeah, these were at 4.9%, 5% almost. Last year in October, they were at, 4.7% roughly. earlier this year in March and April. But since the Fed started to kind of pivot away from the tightened policy and rate cuts become more and more expected, that's when we start to see decreases in bond prices to kind of sympathy into it. So that's kind of what you see here. This is 10-year bond yields. This is yields. Yields are going to go down. Bond prices are going to go up. This is yields, just to clarify. Sorry. But yeah. Jane bonds. Yeah. I'm drinking stevia cola. It's a sugar-free soda with caffeine in it. The Fed decision's at 2 p.m. It might be in big letters, Oh, sorry. Here, hold on. I gotta add another one. Whoa. Yeah, it's all right. Try to go up. I guess I'll go up there. Yeah. Here, please stop spamming. You're gonna get banned pretty quickly if you spam it. If you say it one more time, you're gonna get banned. Okay. Sit in the corner and think about what you've done. You're in timeout, sir. Think about how terrible you've been. Anyways. Ugh. All right, guys. Hey guys, so basically what are the outcomes of 25 and 50? Nobody knows, and anybody that claims to know is just speculating. We can look at the outcomes of rate cuts throughout history. I think that's a good thing. All right, so historically, when the Fed pivots from a rate pause to cutting rates, it generally signals a shift in policy due to concerns about economic growth, inflation, or financial stability. Short-term optimism generally happens, so initially markets often respond positively to the original announcement of rate cuts. Lower interest rates are seen as supportive for economic growth, earnings for corporate, like for stocks basically, and valuation. Stocks may rally immediately afterwards, but it's never 100%, and we don't really know. Bond prices typically rise and yields fall because, again, the more bonds, lower rates reduce the attractiveness of newly issued bonds is what it really is compared to old ones, and pushes the prices for older bonds up and newer ones. Obviously, it's dilution of bonds is the easier way to put it as bond prices. Long-term reactions depend. In 01 and 07, in both cases, the Fed cut rates to starve off economic weakness. Markets eventually corrected and declined down due to the bursting of the dot-com bubble in 01 and the financial crisis of 2008. We also had a little stuff like this in 95 and 96. The Fed cut rates in 1990s after a rate hike cycle, and the market responded positively. It extended the bull market into the late 1990s. So, it depends on which one you think we're in a similar way with. Typically, though, bonds perform well, interest rates decrease, bond yields fall. It drives prices up because, the flight to safety can also occur if the economy is expected to weaken further. So yeah. It can be a precursor to a recession as well. So like sometimes it depends. It's kind of like picking up pennies in front of a train track is the way I always try to describe it. I think that's one of the most effective ways so you can understand monetary policy and economics. Like generally, yeah, so here's, again, I'm going to put gold up on the right side. So here's gold. Put a 5-minute chart up. Gold's pretty flat, but sitting at just under 2,600. Here's the SPY today. Here's NVIDIA. Greetings from Geneva. I'm short in the Geneva, huh? I have no idea how this market's going to react. I can see 2% up or down. Is 50 bullish or bearish? I don't know. I hope it's bullish. Can you cover the US 30? Yes, the Dow broke highs yesterday. So the Dow broke highs. If they cut 75, the market probably is going to freak out. The reason I don't want them to cut 50 is because the market could freak out from that. Like, if we cut 50 basis points, that means what, right? That means the market might be breaking. Like, the market could be weak and breaking, and I don't necessarily think that's good. I think, I think a lot of stuff has scared people in terms of, like, the economy predictions. I think, one of the things was this big revision to payroll data we had a couple weeks ago. That scared a lot of people. GDP is still relatively strong, though. And look at the SPY push-up. So GDP's at 3%. I'm pretty sure it's at 3%. What was the last? It was the first revision data. The last GDP report showed 3% increase from the first quarter of 2024. GDP increased by 1.4%. Second quarter estimate was revised up by 0.2% points from the initial estimate. It increased at a 3% annual rate in the second quarter of 2024. So GDP at 3%. That's generally optimistic, but I think a lot of people are nervous about it because of everything going on. Again, SPY's at the all-time highs. Nvidia's back up over 100 at least. Gold has been breaking lifetime highs for the last few months. So, yeah. I'll try to put this. I'm trying to position myself in a better way. Maybe I'll put it like right here. Like right at the middle here. So it's 3% annually. GDP's always seen annually. Like it bumped up 1.2%. Let me see how much it bumped up quarter to quarter. SPY rip it up to 564s. The lifetime highs on the SPY. Hold on, guys. Lifetime highs are right here. So this is the lifetime highs on the S&P 500 SPY, basically. The SPY tracks the S&P 500. 566.50. So the new lifetime highs are right here on the SPY and thus the S&P 500. So yeah, so G-Man, I want you to understand something, brother. So, you hear a lot of people, and I see a lot of people streaming this, that call every rate decision a rate hike. And again, if you say that in finance circles, they're going to make fun of you. A rate hike is a very specific thing, but a lot of people that don't really understand economics on YouTube start covering rate decisions, and they saw one that was called rate hike. This is when the Fed was actually doing rate hikes. And they thought that was a universal term for rate decision, and it's not, right? A rate hike is what it sounds like, which is raising the federal funds rate. The Federal Reserve did this really actively when they wanted to combat inflation, right? So if we look at the Fed funds graph, which is what they're controlling here, the Fed funds graph, and again, it's all love. If you didn't mean it that way, it really is all love. I'm trying to help because I see a lot of people call it rate hikes whenever this is actually a rate cut. It's the opposite of a hike. But here's the federal funds graph. Okay. Let me zoom in. Here's a 5-year period. And I'm going to get rid of these words. So here's a 5-year period. Okay. So after 2020, what happened here is that 2020 happened. Everybody freaked out. They got really scared, including the Federal Reserve. And so how does the government act when they're scared of an economic recession or depression? How does the Federal Reserve act? They bring interest rates down. They print money. This stimulates the economy, helps save us from worse recessions and depressions. And so after 2020, they cut rates. They brought them down to almost zero. They did QE. They printed money. They injected liquidity. They sent out stimulus checks. They brought interest rates down to almost zero, and they maintained them at these low rates. right? And they did that, and the consequence of that, again, Rolex prices doubled. Louis Vuitton prices doubled. Grocery prices freaking doubled. And so inflation spiked up to 10% at this period of time. And everybody starts panicking. And so when the Fed sees the inflation spikes, they panic about that end, which is the opposite of cutting rates. And so what do? They start raising the federal funds rate. And this whole angle here is rate hikes. They raised rates, roughly 25 to 50 basis points. Sometimes they did 75 basis points up, all the way to July of 2023 or August of 2023. And then since August of 2023, they've been pausing interest rates at these pretty restrictive high levels. And they're doing this to combat inflation. And so over the last year, what have you seen inflation do? Inflation's been dropping pretty regularly, and this has ultimately helped the market go up. This has helped the stock market go up. Why? Because inflation was lower. When inflation is low, people can afford more things, even though it can help or hurt stocks depending on the context of it. But the market has somewhat reacted positively, and stocks have been breaking highs and highs. Inflation has returned from what it was, which if we're looking at like CPI inflation, from like 10, 11% down to 3%. If we're looking at what the Fed uses, which is called the PCE gauge, the personal consumption expenditure, the Fed specifically uses core PCE, which excludes food and energy prices because those are a little bit more volatile. I think that's at 2.6 right now, I think is what it's currently at. But the point is, this restrictive stance by the Fed decreased inflation in theory, They also pivoted from what's called a dovish Fed that's printing money with quantitative easing, which is, again, the Fed buying up bonds, expanding their balance sheet, injecting liquidity, to a hawkish stance, a restrictive stance, which means that they are no longer buying bonds, but they are instead letting their current balance sheet run off and mature. Like bonds mature. If I got a 5-year bond at 5%, that means the Fed's going to pay me 5% annually. And then at the end of that 5-year period, I'm going to get my money back. The bond will what's called mature. Right, so the Fed's been doing what's called passive QT to let their bond holdings run off. This takes liquidity away from markets, allows interest rates to stay high as well. And again, the reason this meeting is so important is because for the first time in a year, the Fed is going to cut the federal funds rate back down. And again, the question is, how much is it going to be? Again, we're talking about percentage points here. We're talking about decimal percentage points. So 0.25% is 25 basis points. 0.5% is 50 basis points. 75 basis points is 0.75%, so forth and so on. And so, the point of all this is that over the next few years, as long as the Fed continues to cut rates, which is what they said their plan is, interest rates will start going down across the country. There's a lag. It takes time, but interest rates will start going down. The big argument, the big debating factor here is how much should they cut? Typically the bigger the cut, the faster they cut rates, the more panic inducing it is, because why would they cut rates really, really quickly when the Fed's generally balanced? It can cause panic. People can freak out. And so that's kind of what this whole thing is about. Another thing, like when Powell speaks today, that's going to be arguably, some people are saying that's going to be more important than the rate decision. I don't know about this time. I think because it's so freaking polarized back and forth, everybody's checking the CME watch tool. Mine's not even loading right now. Look at this. Everybody's panicking. Everybody's freaking out. Everybody, they want to see what's going to happen. Right now, we're actually pivoted back up. So right now, and this has been right for years straight, the CME watch tool. It hasn't been wrong yet if you check it, 10, 15 minutes before the report. Right now, we're looking at 61% chance of a 50 basis point cut, basically 0.5%. And the Fed says they're going to continue to cut rates. So if they continue to cut rates 50, 50, 50, 50 for the next 4 meetings, then that's going to be a full percentage point. Or no, that's going to be 2 full percentage points. I'm sorry. So, ultimately what it means is around the country, rates are going to start going down. And again, generally it can scare, it can be good, it can be bad. We don't know. And that's what's so up in the air about this, is nobody knows how the market's going to react short-term or long-term to this. And so we'll see. Vote on the poll if you want to put your 2 cents into what you think is going to happen, though. Yeah, we're not going to pause. We're not going to pause. That's just not even a likelihood of. It's just not going to happen. There's not even an option for it. And so again, we're not going to pause. I wouldn't mind a pause, to be honest. But again, I have my own selfish reasons for not wanting a pause. Or for wanting a pause. I don't want prices to go up. And as rates are lower, especially if the Fed does QE, which I don't know if they're going to. I doubt it. But inflation is going to increase. You know, the more people that spend, the more inflation goes up. You know, so either way, rates are going to start going down. You know, that's the whole point of this meeting. Rates are dropping. You know, they're going to drop today. Short-term rates, the amount that banks charge each other to hold money overnight, are going to go down today. It's called the federal funds. Eventually, it's going to trickle into everything else, but it takes time. Hey, what's up, Connor? On pause options? I don't know. I tried to tell him, you know. I say this every time. Every Fed meeting, I feel like I say the same thing. Where every single Fed meeting, somebody in chat is betting on something so wildly unexpected that it's just one of the biggest sucker bets I could ever see. No offense. It's all love. I think it's dumb, but it's all love, you know. An example of this is like betting that the Fed is going to pause today. Again, maybe I'll eat my words, right? Let me prepare for that just in case. Maybe we do pause today. You know, and if we do, I will be shocked, and I think the markets are going to be shocked as well. But nothing's definitive. To be fair, nothing's definitive. Anything can freaking happen. It's pretty improbable. You know, it's possible. It's just very improbable. And I think it's a really risky bet. So we'll see. But again, to be fair, I genuinely don't think we're going to pause today. Right now, it's 60, 40, 50 basis point cut. So. Because there's some, Steve says, how come it affected mortgages straight away when they were raising, but now it could start dropping? Because, well, there might be some what's called sympathy movement in mortgages immediately, right? Banks prepare themselves, lenders prepare themselves, everything like that. There might be some sympathy effect there. You know, they want to get ahead of the curve, start lowering rates earlier, get some business, whatever the argument is there. But that happens. That's normal. John, did you ever look at that betting site about guessing the interest rate decisions? No, not really. It's a derivative site. I can't remember who it is. They wanted to sponsor me. I can't remember what the site was. I've gotten the last like 3 or 4 CPI reports exactly right. I've predicted them exactly right for 4 CPI reports in a row, 4 months in a row. I wonder if I could bet on CPI, because I don't know how I've gotten them exactly right. It's not like it's the same thing every time. There's generally some variance in what it shows up as, but somehow I've predicted it exactly right every single time, and it's been different outcomes. So, you know, my dad always told me, funny story, my dad always told me that I was a great descendant of Giles Corey from The Crucible. If anybody knows the book The Crucible, Giles Corey was one of the first men to be executed during the Salem witch trials. I guess they thought he was a wizard or something like that. And I've kind of made jokes about it in the past, but, you know, maybe that's why I'm getting CPI report right. You know, I'm not saying it is, but, you know, I'll play along. He just said the chance of a pause is basically zero. It is. It's basically zero. Can you please do the best you can to explain what's going on in the simplest terms possible? The Federal Reserve controls interest rates across the country. You know, it's short-term rates. That's what they're controlling, but they will eventually trickle into mortgages, auto loans, bank loans in general, commercial loans. It'll trickle into everything else. And so if the Fed cuts rates, they are bringing essentially what you could look at as like the universal interest rate around the country down. And that's going to bring interest rates all around the country down. There's a lag. It takes time. But that's what the Federal Reserve is doing. But you might think, hey, we should always have a strong economy. Why not just always maintain a super low interest rate environment if that's the case? We could stimulate the economy. The economy will always be good. Everybody's all happy. Sunshine and rainbows. The problem with that is that inflation happens. The more people spend, the more prices rise. And to a certain extent, prices have gone up so much in the last 5 years, it's not sustainable to just maintain rates at almost zero and let everybody have cheap access to lending like constantly. It's not sustainable. And so if the Federal Reserve thinks inflation starts to spike like it did after the low interest rate environment of 2020 or 2021, the Federal Reserve will raise interest rates. It's called a restrictive monetary policy, and it's exactly what it means. The Federal Reserve is restricting the economy to push spending down, because the more restriction in interest rates, the higher they are, the less people spend, the less cheap access to loans they get, and the less they spend. The lower interest rates are, the more everybody has cheaper access to loans. People refinance their homes and spend that money on stuff. People buy more homes in general. Usually prices go up. It's so generally a thriving economy is good, but too much of anything for too long is bad. And so I think that's the point. And so today is the first time the Fed has basically raised rates since 2020. Inflation spiked we had a low interest rate environment of 2020 from the pandemic. The Fed basically saw inflation spiking as a consequence to that. And inflation went up to 10%. That's why a lot of people are still unhappy to this day, because inflation went up so much. So the Fed basically raised interest rates for a period of time. And then for the last year straight, they've paused interest rates at these high levels, restricting the economy, bringing inflation down. And again, today is the first day in years, in 4 years, that they're actually cutting interest rates. And it's the first day in a year straight that they are moving rates back down, or moving rates at all. They've been pausing rates for a year straight. So that's what's going on today in 15 minutes. That's why it's such a massively important thing, So I hope all that makes sense. Right, the way I was explained to it, the art of size, he said it was his wife, they wanted him to confess. Right, the way I was explained to it is that if he confessed, they would take everything. The state would take everything he had. And so in order to be able to, give away some of his assets to his inheritors, he was famously known as saying more weight, basically F you, put more weight on there, I'm not going to confess. And so, yeah, interesting story for sure. But again, I'm a direct descendant of him. My dad's always told me that, which is interesting. It's the only famous person I'm really a direct descendant of. Yeah, another reason we had inflation, obviously, was the stimulus checks. So, those are problems too. It is what it is. I can't really knock the Fed or the government, because we were kind of in a really weird situation after 2020. It's nobody's fault, really. I mean, you could maybe argue, but kind of a super random negative event happened across the world that influenced everything else, caused problems. Inflation also went up because of, shipping and supply chain. When all that stuff's happening, it hurts the supply chain, it hurts shipping, and that gets more expensive, and so they raise prices. And again, it's also, like I said, where inflation causes expenses to be more, and then they raise rent prices, so it's affected everything. Imagine if they continue to pause. It's so unlikely. I don't even want to speculate on it, but I mean, of course, if it's, generally speaking, we do what's expected for the federal funds rate decision. So generally we're going to do what's expected, right? Now, it could be anything. Nothing's definitive. Basically, nothing is 100%. It could be anything. But usually it's as expected. And so what that means is, if we do something that's just super wildly outside of the expected outcome, that's when we're going to get big volatile movement in stocks and bonds and gold. If we, an example of this is, if we do a 75 basis point cut, the market might panic. The market's going to say, wow, something's broken. Let's sell, right? And on the other end of that, if we pause rates, which is, again, just super unlikely, the market might say, oh no, we're going to spiral into a worse economic state. And so again, we'll see. Both of those outcomes are incredibly unlikely. And again, I hope you guys understand, I watch every Federal Reserve decision. We cover it. We stream all of them. Pretty improbable. I'm not going to say it's impossible. Maybe I'll eat my words. It's pretty improbable. I've gotten every rate decision right for over a year. And it's pretty easy to. That's not even saying much, because it's very easy to. Yeah, the most boring thing is a 25 basis point cut. And that could do either one. It could go up or could go down. Nobody really knows. We'll have to wait and see. What's up, G? All right, bro, I got you. Here, hold on. Here, this is the full playlist. I gotta find how to share it. Oh, here it is. Here you go, bro. Playlist. This playlist is 2 days long. I've been building it for about 5 years, just to clarify. So you're welcome. There it is. I'm scared. Well, we'll see. 50% or 50% would signal a potential upcoming recession. 50% of what? You mean 50 basis points would be 0.5%. Of the federal funds rate. Basis points is just 0.5%. 50 basis points, I mean, it's just 0.5%. What if they raise rates 75 basis points? It will induce panic almost certainly. Why? Because generally it means something's breaking. So basically the logic is that why is the Fed raising rates so much so quickly? The Fed usually eases into both, right? So the Fed will do, like, an example of what they'll do a lot of the time is they'll do 25, 50, 75. That's how they ease into 75 basis points rate. That's what they did when they raised rates as well in 21 and 22. Is they did 25, 50, 75. So they'll ease into it. So to pause for a year straight and then all of a sudden just boom, 75 basis point cut, what would you think? You're going to be like, why are they doing this so quickly? What does this mean? And generally it means something's breaking. And so 75 would be a mistake, I think. And Powell's usually balanced. He's not usually one to be brash in that regard. Again, we're looking at the poll numbers here. You can see how much traffic's on this website already. And again, we're going to cover the full stream right here. You won't have to go anywhere. Yeah, so again, let's see if it popped up. Yeah, so 57-43. So we're still pretty split down the middle, chat. We're still pretty split down the middle. We got 10 minutes left. Pretty split down the middle. Yeah, we'll see. All right, we got about 2,300 people already. Still got 9 minutes left for the rate decision. Problem is they're using lagging indicators and rate changes take months to kick in. Usually they take a little bit. Yeah, they'll take months, 6 months to a year plus. So the press conference is at 2:30. Por favor. The actual decision will be at 2 p.m. and we'll cover it all live right here. The reason we get thousands here is because we cover it reliably and quickly. So, again, gold's chopping sideways. The reality is, and again, one of my biggest edge systems in trading right now is waiting for big economic releases and being aware of them and then trading very obvious ranges that we get. Market's usually sideways boring ahead of these reports, and so we can trade the chop pretty easily, just buy the bottom, sell the top. It's not super exciting, but all these traders want to ride breakouts and breakdowns and excitement and all that stuff. And again, usually I'm just pretty simple, pretty easy. Identify a choppy neutral range and then attack that range. An example of this today on the SPY would be this. We've been talking about this all morning, all yesterday. Very easy rectangular range. Once you get polarized down at the bottom, you can ride it up to the top and then bottom, top, bottom, regardless of what it does. We got a lot of this at the opening bell the last few days, and especially this morning in pre-market, we saw choppiness today too. So we'll see. Big range, but choppy nonetheless. Can you talk about the impact on stocks? Well, 25 is kind of a neutral outcome. I don't know how the market's going to react. 50 is a little bit more edging towards, or 50 is a neutral report now, although I disagree with it. I think it's too much, and it might scare people in stocks. It might not, though. I don't know. Again, historically, when rates are cut, the market actually reacts positively if we look at the history of it. But again, we don't really know. We'll have to wait and see. So the rate decision is at 2 p.m. The press conference is at 2:30, and we'll stream the press conference. But the actual rate decision is at 2. And again, we're going to cover all of it live. We'll stream the whole thing. Yeah, 50 neutral, 25 dovish, 75 is panic, 100%. That's right. That's correct. 100 is what? 100 is deep panic. So yeah, 100 is like a lot of panic, like freak out panic. All right, I'm gonna put it in sub only mode, chat. So if you haven't already, hit that subscribe button, hit the notification bell. We got almost 3,000 viewers right now. So hey, I appreciate the love. Thanks so much. You'll be able to see the decision right here. We'll cover it. Market's gonna crash today for sure. Yeah, well, generally, everybody always says the market's going to crash every single FOMC decision. Usually it comes from like day traders trying to predict it when they're not really paying attention to economics. A pause is almost certainly not going to happen. Yeah. So a pause is almost certainly not going to happen. So again, right now it's at 57.43 in terms of rate decisions. We got a little bit over 5 minutes left. We're at 57.43. So basically 57% of people think that we're going to do a 50 basis point cut. 43% of people think we're going to do a 25. Again, the Fed watch tool is down right now too, which is interesting. I personally think Powell will do anything crazy, 25 or 50. Yeah, we'll see. One of the most important moments in the year, 100%. It's a huge moment. Guys, a big moment in stocks. All right, guys. Sorry. So we got 3,000 people here watching. We still got 4 minutes left. SPY is choppy in anticipation. Apprehensive traders that don't want to take a big position ahead of it is what's going on right now. That's basically what's going on. John, what hurts most, a rate cut or the gov? It's hard to speculate on that. Depends on what happens with the shutdown. Yeah, hit that like button, hit the subscribe button. Well, yeah, I mean, everybody says 50. Right now, 50 is what's probably going to happen based off of the CME watch tool. You know, like, again, I think it's going to be 50 as well, just based off of the CME watch tool. Everybody else does as well. But it's about a 55-45 split, and it's pretty accurate. The CME watch tool, you know, has been right every time for years. And so that's probably what's going on today. It looks like the server's actually down a little bit. But yeah, that's what's going on right now. All right, guys, we got 3 minutes. 3 minutes, 2.5 minutes, really. Hit the live button next to the play button. Make sure you're fully caught up on stream chat. Yeah. We got about 3,500 watchers right now. I appreciate the love. Let's get ready, guys. Again, we're going to cover it fast. Make sure you hit the live button next to the play button. Make sure you're fully caught up on the stream. We appreciate it. Yeah, the CME watch tool is completely down right now. Interesting. All right, guys, here we go. Be ready. 2 minutes left. 2 minutes left. I'm excited, man. This is the first rate decision that we've had in a while that's kind of got my blood pumping a little bit, man. This is interesting, for sure. Well, everybody uses the Fed watch tool, the CME watch tool. Everybody uses that. That's why it's down right now. That's because, but again, pretty probable 50 basis point cut. It doesn't mean it's going to happen. It could be 25 as well. Outside of those two options, 50 and 25, you know, it's very, 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 very improbable. Very, very, very unlikely that we're going to do anything outside of those two. All right, guys, we got a minute and 10 seconds. Hit the live button next to the play button. Here we go. Markets are mostly flat, middle range on the day. Gold's pushing down. We got 1 minute. 1 minute left, guys. 1 minute left. Get your last minute predictions out in chat. Is the first rate decision outside of a pause in a year straight. The first rate cut in 4 years is about to happen in 50 seconds. Guys, 50 seconds. Be ready. Here we go. Big moment in time right here for markets, to be honest, man. I'm pretty pumped about it. I'm excited. Big moment in time. Again, almost certain to be 50. We'll see what we get. And yeah. It's a monstrous day here. Yeah, the CME watch was down. They probably can't handle all the traffic. All right, guys, 20 seconds. $100 basis points. Put your last minute predictions out in chat. Again, hit the live button next to the play button. Make sure you're fully caught up on stream, chat. Fully caught up on stream. And again, we will cover it live as soon as we get it. All right, guys, 5 seconds. And here's the report. Here's the report. Markets are so far up. Markets are up. We're waiting for the report to reflect here. But markets are pumping up here, guys. Pump it up. All right, here's the HTML. Each participant is based on all right, the Fed cuts rates 50 basis points, as we said we would. And again, we're going to go ahead and read the economic stuff here. So again, we're going to go ahead and read this for you. In conjunction with the FOMC meeting held on September 18th, meeting participants submitted their projections for the most likely outcomes for real gross domestic product growth, the unemployment rate, and inflation for each year from 24 to 27 of the long run. Their projections were based on info available at the time of the meeting, together with his or her assessment of appropriate monetary policy, including a path for the rate and its longer run value and assumptions about other factors likely to affect, again, 50 basis point cut. Guys, 50 basis point cut. I'm going to put this up on screen. It was 11-1. Bowman called for a cut of 25. And so again, I'm going to put this up. 50 basis point cut. 11-1. Bowman voted for 75 basis points. And again, the longer run projections under appropriate monetary policy in the absence of further shocks to the economy. Appropriate monetary policy designed the further path of policy that each participant deemed most likely to foster outcomes. Carol. Hey, baby. The longer run projections represent each participant's assessment of the value to which each variable sorry, I gotta get my dog out of here. I'm trying to read.
Bruce. Come on, Bruce.
All right, sorry. 50 basis point cut. I'm reading the statement. The longer run projections represent participants' assessment of the value to which each variable would be expected to converge. Yeah, so I'm looking at these real GDP changes. So 50 basis point cut. So far, the stock market has churned up on this report. Churned up. 50 basis point cut by the Federal Reserve. Nvidia up to 117s. Yeah, Katie, or my wife, or my dogs come in here at the worst times. Every day. Every day. Literally, they came in here at 8:30 Eastern Standard Time today, right when the economic data came out. That dog can time the market. Hey, 50 basis point cut, as we told you guys. Again, people betting on no cut. People betting on 75, 100. Again, y'all got to understand economics. No offense. Again, it's all love. It really is. I'm trying to help you guys understand everything. But yeah, we ended up doing a 50 basis point cut, as we said we would. And again, here's the statement. Recent indicators suggest economic activity has continued to expand at a solid pace. Job gains remain strong. Unemployment remained low. Inflation eased but remains elevated. In recent months, there's been modest further progress toward their 2% inflation objective. They seek to achieve maximum employment and inflation at the rate of 2% over the long run. They judge that the risk to achieving its employment and inflation goals have moved toward better balance over the past year. The economic outlook is uncertain. The committee remains highly attentive to inflation risks. In support of the goals, they decided to maintain the target range for the federal funds funds rate, cutting it 50 basis points. And considering any adjustments to the target range for the rate, the committee will carefully assess incoming data, evolving outlook, and balance of risk. They do not expect it will be appropriate to reduce the target range until it has gained greater confidence that inflation is still moving sustainably towards 2%. In addition, they will continue reducing its holding of Treasury securities. So basically, they're going to continue to do quantitative tightening, passive QT, and agency MBSs. They are strongly committed to returning inflation to its 2% objective. In assessing the stance, the committee will continue to monitor implications of incoming information and economic outlook. So yeah, basically 50 basis point cut is what happened. They see 50 basis points more cuts this year. So basically they think they're going to move rates down a full 1 percentage point, including this one. So basically what I'm guessing here is that we do 50 basis points this meeting, 25 basis points next meeting, 25 basis points the meeting after that. That'll be 4 meetings left. That'll be a full percentage point cut, a 100 basis point cut for the rest of this year. And so 50 today. In 6 weeks from now, we're probably going to do another 25. And then 25 at the following meeting afterwards is what it looks like to me, right? And again, we're going to stream the entire press conference. Guys, we're going to stream the entire press conference. Stick around. Again, we are going to stream the entire thing today. So stick around. Again, we'll see what happens. Massive day for markets, chat. Massive day. Absolutely freaking huge. And yeah. The question is this good or bad for markets? And does the market hold? The market's up a little bit today, but it's not up like a ridiculously large amount. And again, let me put the timer up. The Fed meeting, the actual press conference is in about 25 minutes. (2:30 p.m. Eastern Standard Time. And so again, we'll put a timer up. We got 24 and a half minutes left. All right, so this is when the press conference starts. We'll put the timer up there. Nvidia, gold, everything's spiking up on this report with low interest rate environment. And yeah, we'll see what happens, chat. We'll see what happens. All right. Change the title here. Yeah, so the full meeting is at 2:30. The question is, now the big question. I'm going to end this voting poll so that people understand. Yeah, honestly, guys, like, look, man, these rate decisions. I made a video. If you watch the video, okay, if you watch the video I published yesterday, okay, the problem is that you got people that are day trading. You got people that want to shock people. You got people that benefit from shock value. And so what do they say? They put out all these ridiculous expectations, like no basis point cut, like we're going to pause today, guys, or we're going to do a 100 basis point cut. And again, these come from people who don't understand economics. Like, they don't understand economics. What I said in the video is that if you check the CME watch tool 20-30 minutes before the rate decision, that's what's going to happen. And again, if you checked it 30 minutes before, it said 50 basis point cut. Obvious. Anybody that understands economics should understand we're not going to pause rates today. We're not going to 100 basis point cut. And again, this comes from people that are highly influenced by the media, by news, by people on YouTube that want to shock people and make some wild contrarian prediction. Be smart, guys. Understand. Like, listen, I've gotten every single rate decision correct over the past few years straight. It's not hard to do. It's not saying much. But the people who are guessing these wild things genuinely don't understand economics. They don't understand what any of this means. A lot of them are calling them rate hikes. You know, when this is a rate cut, it's the opposite of a rate hike. Yeah, it's common sense. You were just lucky. Yeah, true. Top 3 luckiest trader of all time. You were right. Just made 500 trusting you. Hey, congrats, bro. Again, we'll see what happens. I'm ready. I'm ready. We'll see. We'll see. Again, if you want to check out one of my sponsors, check out Top Step. Top Step funded account program in futures. If you want to day trading can be profitable, but if you want to do it, do not put up $5,000, $10,000, $2,000 yourself, risking that in day trading. It makes no sense. Almost all day traders lose money. Doesn't matter what your guru tells you. Most day traders lose. Try a funded account program in futures. In the futures market, you can day trade the S&P, the NASDAQ, gold, some currencies, no PDT rule. The patterns are very similar to stock patterns. There's just no PDT rule. You can trade these funded account programs. Top Step's one of the most legit in the world. What they do is they give you a demo where they test your skill. The base one is $49 a month. Very cheap. They give you a $50,000 demo if you can make $3K without losing $2K. A very reasonable 2-to-3 ratio. They fund you $50K, 90% split. You get to keep your first $10K, and they've paid out over $40 million to their traders. If you lose, your risk is minimized. It's only $49 a month. Good risk reward there. You know, you're risking $49 to potentially get funding if you're good enough. And if you lose money on there, which is most day traders lose, it doesn't matter where they go, you probably would have lost more putting the money up yourself. Again, they're a sponsor of mine. They pay me money. I am biased because of it. For sure, I'm biased because they pay me money. If they paid you money, you'd be biased too. Genuinely one of the better ones. And the best part is that on Top Step X right now, on their trademark platform, there's zero commissions. So you can basically trade micro contracts with zero commissions, which is incredibly powerful, incredibly useful. It's just genuinely like really, really, really powerful. And that's what people have to understand. One of the best edges in trading right now. You got to use Top Step X though. It's literally like the best way to do it. No commissions. No commissions. If you want to check it out, I'll put that link up. We'll day trade a little bit after this, but there's the link if you want to check it out. Again, they're a sponsor of mine. 2:30 Eastern Standard Time. Hey, nice, Craig. Robert. All right, guys. Again, market's pretty split, pretty indecisive. 50 basis point cut is neutral. And again, the question is, what is Powell's tone like? Again, we're going to do another poll here, guys. We're going to do another poll. We asked how many people are going to cut rate or what people thought regarding the rate cut today. The next question for our poll is Powell hawkish or dovish? Again, hawkish means he might cut 50 basis points today, but still want to maintain a restrictive monetary policy for the rest of the year. And so will Powell be hawkish or dovish in tone? All right, so again, dovish, meaning low interest rates, or hawkish, yeah, dovish or hawkish. I'll put the poll up right now. All right, guys, there's the poll. Vote on that poll. Let me know how you feel. Again, we will stream the entire press conference live. And in certain situations, it's more important what Powell says during this event. If we do what's expected, which we did today, 50 basis point was what was expected. The real question is, what is Powell's tone? Vote on the poll. Let me know what you guys think. All right, so now is the full press conference, guys. The full FOMC press conference. Hey, thank you so much for becoming a member, David. I appreciate it, brother. Thanks so much. It's bad. Weren't you saying that they would do no rate cuts today? He said, glad I sold. That's experience. Didn't you say they would do no rate cuts today? Weren't you one of them? I don't know for sure. I'm just kind of messing around. Yeah, well, what I said, Gaurav, is this, right? So basically my sentiment, you're correct. Gaurav said, told you in earlier stream today that Powell's tone is always important, but you said this time it's different. So what I said earlier is a little bit out of context. What I said is that generally we were arguing about which one's more important. Not important in general. They're both important. Obviously, they're always important. But what's more important in this specific instance, right? And what I said was that if we do what's expected, the tone's more important. Right, so if we do what's expected, what is wildly expected to happen, in this case it was 50 basis points, in that situation, the tone is more important. If we do something outside of the expected number, like if we were going to cut 25 basis points, that would probably have a much bigger impact on markets than the tone of Powell during the press conference, right? So it depends on what happens. Like it depends on the sequence of events that occur is going to mean which one's weighted in terms of volatility. Anyways, NVIDIA coming back down. We're completely flat. Right now, guys, we are completely flat. Also, hit that subscribe button. Hit the notification bell. Help me hit my goal of 150,000 subscribers, chat. Help me do it. We're getting close. We're getting close. Do it now. Listen, I'm not going to pressure you to subscribe. But if you don't right now, I'll hate you forever. Subscribe now. You know you want to. It might feel good. Try it one time. You know, peer pressure. Everybody's doing it. It might feel good. Subscribe now. Hit the notification bell. You'll get alerts here, guys. Coming from the top 3 worst trader of all time ever in the world. Do it now. Always so sassy. Top 3 in the world. Sassiest, I guess. Yeah, you're definitely 50% happier. You're probably one of the top 3 happiest people in the world right now. Hey, listen. Market's bouncing right back up. Here's a little technical analysis thing. These are some of my favorite levels. You'll see 3 levels that I have on my charts, right? Previous closing price, the red to green level of the stock in the market. If it goes up, if it's above this, the S&P 500, the SPY is technically green on the day. If it goes below this, it's technically red. Very relevant milestone level. The 200 EMA, long-term moving average, almost every trader watches it. 200 exponential. Almost all traders are watching the exponential moving averages, the 200 exponential. The volume weighted average price, another highly used indicator. So what happens? You get all 3 of these levels right around each other. Same point. Some traders are buying the VWAP, some traders are buying the 200 EMA, some traders are buying the previous closing price. Regardless, they're all 3 buying it. And so what happens short term, and this is really only short term. Anything could happen long term. This is more moved by fundamentals, especially with what Powell says during the press conference. Short term, we get a very obvious bounce there. You know, now, again, what's going to influence all of this, fundamentals trump technicals. You could have the best technical indicator outside of extension, I would say. But if something crazy happens during the FOMC meeting, if some crazy event decision happens with Jerome Powell, it will completely wipe out the technical indicator. You could have the best crossover ever. It's completely insignificant when it comes to fundamental economic releases like this. And that's important to understand as well. Gold's pushing up, chat. So gold's moving up. Gold's up to 26.20s. Again, NVIDIA bouncing up as well. It's at 115s, almost 116s. Rate cut's not really going to affect GameStop very much at all. The only implications it might have on GameStop is how much they pay in rent for their stores. So like that, you might be able to look at some angle there where interest rates are lower, so maybe they get better rent, and then they might be a tad bit more profitable. But again, pure speculation, guess, no idea if that's going to happen. But it makes sense, I guess. Your top 3 in the world? Definitely top 3-ish. Again, I'm not even claiming to be a good trader, right? Top 3 worst of all time, they say. All right, guys. Hey, 13 minutes. 13 minutes. Gold is not flat. I don't know. Gold's up. Gold just broke highs of the day. Gold just broke lifetime highs, actually, leading into this. And so I guess the thesis on that would be 50 basis point cut makes people worry about the economy. And in that regard, they hedge with gold. That might be one of the reasons gold rising. But again, at the same time, you can kind of see all markets rising. NVIDIA rising, SPY rising, gold rising up a little bit more nonetheless, but still up regardless with all of them. Oh no, I'm mostly a long-term investor slash economist. I day trade, sure, but I do better at swing trading and long-term investing for sure. Yeah. I mean, I think I'm a good day trader too, but you know, that's how it goes. Any giveaway for reaching 150K? I'll give away my love, you know, to you special people here. Yeah, so higher interest or lower interest rates mean that bond prices go up, but their yields go down. And so low interest rate environment, less yields in bonds. Your yields pay out less, you know. And so in that regard, people might hedge with gold, you know, as well because of that. Yeah, you never know. Gold's volatile long term. Gold's volatile long term. I'm telling Carol. Yeah, I mean, she's one of the top 3 wives. She's one of my top 3 wives ever. So I think she'll understand. All right, I got you, Pawn. Hold on, dude. My bad. I forget to open up Discord. Honestly, my computer started sounding like a rocket ship. And so, all right, guys. So, again, Tesla testing highs of the day as well. Gold's consistently breaking lifetime highs. I took a loss today, but I learned a lesson. As you say, I think it's time to study economics more seriously if I wish to continue trading, not in bad spirits. 'Tis the name of the game. 100%, man. I dumped my index funds before this event. Too much of a gamble. Gold and silver, I felt confident about either way. Yeah, so here's the thing, right? People ask me about gold all the time. But, again, people ask me about gold all the time. The problem with gold, and I've said this many times this morning, I'll say it again. The problem with gold is that gold's right in the middle of a long-term uptrend. Gold's been uptrending for years and years now, and so the risks here for gold specifically is that gold, long-term, meaning 20, 30-year period, gold's pretty safe. You know, short-term, it can be unpredictable, meaning it can downtrend for 20 years. You know, it can downtrend for 10 years. You know, generally speaking, what happens is that it has a big upward move and then it downtrends for 5 to 10 years. And we're right in the middle of a big upward move, you know, and maybe we continue to go higher. Historically, it can go higher. I'm not saying it's not going to. It certainly could. But it could also downtrend for the next 5 to 10 years. You know, so in that situation, I'm not really trying to buy gold. It depends on what you think happens with the economy. If you think we're going to hit a recession, depression, maybe hedging against gold's a brilliant idea, right? But if you think the economy is going to keep on churning business as usual with the low interest rate environment that we're getting now, then maybe gold might not be, you know. Again, I'm not telling you what to do. Generally speaking, you zoom out 20, 30 years. There's a very famous saying, when in doubt, zoom out. And gold over a 20, 30-year period is a beautiful investment. It's over the last 25 years, it's gone up like 7 or 8x. It's outperformed the S&P 500, but it's not risk-free. And so people just have to understand the nuances of it. All right. I can't see how people think that Jerome Powell is going to be dovish. He just did a pretty big rate cut. Why would he be more dovish in the future? I mean, he seemed like just in their quotes, right? So if we look at like this here, FOMC cuts rates 50 basis points. They vote 11-1. Bowman wanted a 25 cut. When you look at this, right, they see 50 more basis points for the rest of this year. Meaning, again, like I said earlier, remember what I said earlier is that they ease into it. And so with rate cuts, it looks like they're going to do 50 this meeting, which is what they did. They did 50. The next meeting, they're probably going to do 25. And then the meeting after that, they're going to do 25. And that'll be the remaining meetings this year. So for the rest of this year, basically, they're planning to cut rates from now, including today, to the end of the year, about 1 full percentage point in the federal funds rate. So again, interest rates are going to start coming down universally around the country. It's going to have a lag. It takes time. It's not immediate. There might be some immediate sympathy from it, but I wouldn't hold my breath for it, basically. It might happen. But yeah, 1 percentage point in the federal funds rate this year is what they're planning now. And this sentiment could always change. Ultimately, what you want to watch to see if it does change is inflation. If inflation starts to spike, they might be a lot more hawkish, meaning they might be a lot less willing to do more rate cuts. And so watch inflation close. Again, the Fed looks at personal consumption expenditure index, core PCE is what the Fed looks at. If that starts to continue to slow, great. They'll probably continue to cut. If that spikes up to some crazy high level, they might pivot away from rate cuts for the rest of this year and do something else. And again, we'll cover the full PCE meeting live on the stream. Every single major economic report we cover here on Beginner Trading, And so if you want a one-stop shop for it, again, subscribe. I appreciate it. This is gold, the SPY, and then NVIDIA is on the left side. There is no October meeting. No, it's in November, right? It's every 6 weeks, right? So the next one will be 6 weeks from now. So it will be at the beginning of November is when the next meeting will be. Like first week of November, I'm guessing is I don't know exactly what the date is, but it'll probably be the first week. It happens every 6 weeks. And then 3 weeks from now, we'll get what's called the Fed Minutes Report, which again, we will stream, break down, look at in 3 weeks, which is a detailed explanation on the decisions today. So that's what's going on. All right, guys, I'm going to switch my headphones out. When I do, I want you to let me know you can hear the music. Yeah, that'll be a big, important event too, Big Hoss. All right. So again, like I said, let me know if you can hear it right now. Can you hear it? Let me know. After years, is there a chance this could be named to intermediate trader? I call it beginner trading not because I'm a beginner. I think everybody that hears me understands I'm top 3 least beginner traders in the world right now. But it's a resource for new traders is what it is. Like, we're trying to help people, Okay, you can hear it? No? You can't hear it? Yes, no? Maybe so? Can you hear the music? Okay, because I want to know. I want to make sure you'll be able to hear the FOMC meeting as well. Is why I'm asking that. Yeah, so the next one's going to be November 7th is the next Fed meeting, and then the last one will be December 18th. So again, I'm guessing they're going to do 50 today, 25 November, 25 in December, if they continue with their current plan. Sorry, I'm putting it up. I'm trying to make sure you guys get the earliest event. So I'm going to put 2 different options up. Make sure you guys get the earliest one. You're welcome, guys. I'm trying to make sure y'all got the most up-to-date FOMC stream you can, so somebody's not beating you in terms of data. All right, so bear with me, chat. Yeah, it is kind of cool. We got more people here than the Washington Post, so shout out to Beginner Trading. They get full press conference right now. All right, so again, we got a couple options up. I'm gonna get the earliest one. The one that I see is the fastest is what you're gonna get. So again, you're welcome. We'll kind of design the stream so that you can kind of see all of it. Put this up on the corner. We'll put. I'm gonna put the. I've looked at the SPY a lot. I'm gonna put the QQQ up, and then probably. Would y'all rather the SPY or the Q up as a chart kind of next to the Fed meeting? What do you guys think? Yeah, I mean, it's Connor. It's all love, bro. It's all good, dude. Like I always welcome you here, man. I just don't have any more guests on my stream, really. It's just too much work and too much difficulty to kind of manage it all and kind of risk management type of stuff. But I obviously I appreciate you being in the chat and hanging out. You're always welcome to be here. All right. Yeah, so again, we got less than a minute left. Again, I'm on two different sources. I'm trying to get you guys the most up-to-date one. So let's see, NASDAQ, QQQ, SPY. Yeah. $50 basis point cut is a good decision. It shows that the Fed's worried about a weak economy for sure. All right, so we see SPY, NASDAQ, SPY, Q, NASDAQ, Dow. Somebody threw the Dow. Looks like most people want the SPY. So I'll put the SPY up. And I'll put the SPY up in gold. Because I think that's a good look. We could also look at like the Dixie or something like that. Gold's been breaking lifetime highs, so I think that's probably a pretty good one. I'll go sit in the corner over here. Oh, wait. Okay. Alright. Here we go. Here it is. This is the fastest one.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Our economy is strong overall and has made significant progress toward our goals over the past 2 years. The labor market has cooled from its formerly overheated state. Inflation has eased substantially from a peak of 7% to an estimated 2.2% as of August. We're committed to maintaining our economy's strength by supporting maximum employment and returning inflation to our 2% goal. Today, the Federal Open Market Committee decided to reduce the degree of policy restraint by lowering our policy interest rate by a half percentage point. This decision reflects our growing confidence that with an appropriate recalibration of our policy stance, strength in the labor market can be maintained in a context of moderate growth and inflation moving sustainably down to 2%. We also decided to continue to reduce our securities holdings. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has continued to expand at a solid pace. GDP rose at an annual rate of 2.2% in the first half of the year, and available data point to a roughly similar pace of growth this quarter. Growth of consumer spending has remained resilient, and investment in equipment and intangibles has picked up from its anemic pace last year. In the housing sector, investment fell back in the second quarter after rising strongly in the first. Improving supply conditions have supported resilient demand and the strong performance of the U.S. economy over the past year. In our summary of economic projections, committee participants generally expect GDP growth to remain solid, with a median projection of 2% over the next few years. In the labor market, conditions have continued to cool. Payroll job gains averaged 116,000 per month over the past 3 months, a notable step down from the pace seen earlier in the year. The unemployment rate has moved up, but remains low at 4.2%. Nominal wage growth has eased over the past year, and the jobs-to-workers gap has narrowed. Overall, a broad set of indicators suggests that conditions in the labor market are now less tight than just before the pandemic in 2019. The labor market is not a source of elevated inflationary pressures. The median projection for the unemployment rate in the SEP is 4.4% at the end of this year, 0.4 higher than projected in June. Inflation has eased notably over the past 2 years, but remains above our longer-run goal of 2%. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.2% over the 12 months ending in August. and that excluding the volatile food and energy categories, core PCE prices rose 2.7%. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. The median projection in the SEP for total PCE inflation is 2.3% this year and 2.1% next year, somewhat lower than projected in June. Thereafter, the median projection is 2%. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. For much of the past 3 years, inflation ran well above our 2% goal, and labor market conditions were extremely tight. Our primary focus had been on bringing down inflation, and appropriately so. We are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. Our restrictive monetary policy has helped restore the balance between aggregate supply and demand, easing inflationary pressures and ensuring that inflation expectations remain well anchored. Our patient approach over the past year has paid dividends. Inflation is now much closer to our objective, and we have gained greater confidence that inflation is moving sustainably toward 2%. As inflation has declined and the labor market has cooled, the upside risks to inflation have diminished and the downside risks to employment have increased. We now see the risks to achieving our employment and inflation goals as roughly in balance, and we are attentive to the risks to both sides of our dual mandate. In light of the progress on inflation and the balance of risks, at today's meeting, the committee decided to lower the target range for the federal funds rate by a half percentage point to 4.75% to 5%. This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance. We are not on any preset course. We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment. In considering additional adjustments to the target range for the federal funds rate, the committee will carefully assess incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as expected, the median participant projects that the appropriate level of the federal funds rate will be 4.4% at the end of this year and 3.4% at the end of 2025. These median projections are lower than in June, consistent with the projections for lower inflation and higher unemployment, as well as the changed balance of risks. These projections, however, are not a committee plan or decision. As the economy evolves, monetary policy will adjust in order to best promote our maximum employment and price stability goals. If the economy remains solid and inflation persists, we can dial back policy restraint more slowly. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we are prepared to respond. Policy is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation back down to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Steve.
Steve Leisman, CNBC. Thank you, Mr. Chairman, for taking our questions. In July, you said you weren't necessarily thinking about a 50. You didn't want to be specific, but you said you were thinking about a 50. The inflation data last week came out a little firmer than expected. Retail was strong, third quarter GDP running 3%. So what changed and made the committee go 50, and how do you respond to the concerns that perhaps it shows the Fed is more concerned about the labor market? And I guess, should we expect more 50s in the months ahead? And based on what should we make that call? Thank you.
So, okay, a lot of questions in there. Let me jump in. Since the last meeting, we have had a lot of data come in. We've had the 2 employment reports, July and August. We've also had 2 inflation reports, including one that came in during blackout. We had the QCEW report, which suggests that suggests that the payroll report numbers that we're getting may be artificially high and will be revised down. You know that. We've also seen anecdotal data like the Beige Book. And so we took all of those and we went into blackout and we thought about what to do, and we concluded that this was the right thing for the economy, for the people that we serve, and that's how we made our decision. So that's one question. What was the second and third?
How do we make the, sorry, thank you, sir. How do we figure out in the months ahead, is there another 25 or 50 coming in? Based on what shall we make that call? Thank you.
Sure. So a couple things. A good place to start is the SEP, but let me start with what I said, which was that we're going to be making decisions meeting by meeting based on the incoming data, the evolving outlook, the balance of risks. If you look at the SEP, you'll see that it's a process of recalibrating our policy stance away from where we had it a year ago when inflation was high and unemployment low, to a place that's more appropriate given where we are now and where we expect to be. And that process will take place over time. There's nothing in the SEP that suggests the committee is in a rush to get this done. This process evolves over time. Of course, that's a projection. That's a baseline projection. We know, as I mentioned in my remarks, that the actual things that we do will depend on the way the economy evolves. We can go quicker if that's appropriate. We can go slower if that's appropriate. We can pause if that's appropriate. But that's what we were contemplating. Again, I would point you to the SEP as just an assessment of where of what the committee is thinking today, what the individual members, rather, of the committee are thinking today, assuming that their particular forecasts are realized.
Go ahead, Chris.
Hi, Chris Rugaber at Associated Press. Thank you. The projections show that the Fed officials expect the Fed funds rate to still be above their estimate of long-run neutral by the end of next year. So does that suggest you see rates as restrictive for that entire period? Does that threaten the weakening of the job market that you said you'd like to avoid? Or does it suggest that maybe people see the short-run neutral as a little bit higher? Thank you.
I think the way I would really characterize it is this. I think people write down their estimate, individuals do. I think every single person on the committee, if you ask them what's your level of certainty around that, they would say there's a wide range where that could fall. So I think we don't know. There are model-based approaches and empirically based approaches that estimate what the neutral rate will be at any given time. But realistically, we know it by its works. So that leaves us in a place where we expect, in the base case, to be continuing to remove restriction, and we'll be looking at the way the economy reacts to that, and that'll be guiding us in our thinking about the question that we're asking at every meeting, which is our policy stance the appropriate one? We know, if you go back, we know that the policy stance we adopted in July of 2023 came at a time when unemployment was 3.5% and inflation was 4.2%. Today, unemployment is up to 4.2%. Inflation's down to a few tenths above 2. So we know that it is time to recalibrate our policy to something that is more appropriate given the progress on inflation and on employment moving to a more sustainable level. So the balance of risks are now even. And this is the beginning of that process. I mentioned the direction of which is toward a sense of neutral. And we'll move as fast or as slow as we think is appropriate in real time. But what you have is our individual accumulation of individual estimates of what that will be in the base case.
Howard.
Howard Schneider with Reuters. How close was this in terms of the decision? You do have the first dissent by a governor since 2005, I think. Was the weight clearly in favor of a 50, or was this a very close decision?
I think we had a good discussion. If you go back, I talked about this at Jackson Hole, but I didn't address the question of the size of the cut, left it open, and I think we left it open going into blackout. And so there was a lot of discussion back and forth, good diversity of division, excellent discussion today. I think there was also broad support for the decision that the committee voted on. So I would add, though, look at the SEP. All 19 of the participants wrote down multiple cuts this year, all 19. That's a big change from June, right? 7 of them wrote down 3 or more, and 17 of the 19 wrote down 3 or more cuts, and 10 of the 19 wrote down 4 or more cuts. So, there is a dissent, and there's a range of views, but there's actually a lot of common ground as well.
Follow up to that, now that this is in the books, can you give us some guidance as sort of follow up to Steve on the pacing here? Would you expect this to be running every other meeting once we get into next year?
Yeah, we're going to take it meeting by meeting. As I mentioned, there's no sense that the committee feels it's in a rush to do this. We made a good, strong start to this, and that's really, frankly, a sign of our confidence. Confidence that inflation is coming down toward 2% on a sustainable basis. That gives us the ability. We can, make a good, strong start, but. And I'm very pleased that we did. To me, the logic of this, both from an economic standpoint and also from a risk management standpoint, was clear. But I think we're going to go carefully, meeting by meeting, and make our decisions as we go.
Gina.
Hi, Chair Powell. Gina Smilik of the New York Times. Thanks for taking our questions. You and your colleagues in your economic projections today see the unemployment rate climbing to 4.4% and staying there. Obviously, historically, when the unemployment rate climbs that much over a relatively short period of time, it doesn't typically just stop. It continues increasing. And so I wonder if you can walk us through why you see the labor market stabilizing, sort of what's the mechanism there, and what do you see as the risks?
So, again, the labor market is actually in a solid condition. And our intention with our policy move today is to keep it there. You can say that about the whole economy. The U.S. economy is in good shape. It's growing at a solid pace. Inflation is coming down. The labor market is in a strong pace. We want to keep it there. That's what we're doing.
Sorry, Nick.
Nick Timmeros of the Wall Street Journal. Chair Powell, does today's action constitute a catch-up in action given recent substantial revisions to the employment data? Or is this larger than typical rate cut a function of the elevated nominal level of the policy rate such that an accelerated cadence could be expected to continue?
Okay. Multiple questions in there, but so I would say we don't think we're behind. We do not think we think this is timely. But I think you can take this as a sign of our commitment not to get behind. So it's a strong move. So your other question was?
Well, is this about what happened in the employment data between this meeting and the last meeting, or is this about the level of the funds rate, the high nominal level of the funds rate relative to what might be expected if you're trying to maintain equilibrium?
So I think it's about, we come into this with a policy position that was put in place, as you know, I mentioned in July of 2023, which was a time of high inflation and very low unemployment. We've been very patient about reducing the policy rate. We've waited. Other central banks around the world have cut, many of them several times. We've waited, and I think that patience has really paid dividends in the form of our confidence that inflation is moving sustainably down to 2%. So I think that is what enables us to take this strong move today. I do not think that anyone should look at this and say, oh, this is the new pace. You have to think about it in terms of the base case. Of course, what happens will happen. So in the base case, what you see is, look at the SEP. You see cuts moving along. The sense of this is we're recalibrating policy down over time to a more neutral level. And we're moving at the pace that we think is appropriate given developments in the economy in the base case. The economy can develop in a way that would cause us to go faster or slower, but that's what the base case says.
And if I could follow up on the balance sheet. In 2019, when you did the mid-cycle adjustment, you ceased the balance sheet runoff. With a larger cut today, should there be any signal inferred about how the committee would approach end state on the balance sheet policy?
So in the current situation, reserves have really been stable. They haven't come down. So reserves are still abundant and expected to remain so for some time. As you know, the shrinkage in our balance sheet has really come out of the overnight RRP. So I think what that tells you is we're not thinking about stopping runoff because of this at all. We know that these two things can happen side by side. In a sense, they're both a form of normalization. And so for a time, you can have the balance sheet shrinking, but also be cutting rates.
Colby.
Thank you. Colby Smith with the Financial Times. Just following up on Gina's question on rising unemployment, is it your view that this is just a function of a normalizing labor market amid improved supply, or is there anything to suggest that something more concerning perhaps is taking place here, given that other metrics of labor demand have softened too? And I guess in direct follow-up to Gina is, why should we not expect a further deterioration in labor market conditions if policy is still restrictive?
So I think what we're seeing is clearly labor market conditions have cooled off by any measure, as I talked about in Jackson Hole. And but they're still at a level. The level of those conditions is actually pretty close to what I would call maximum employment. So you're close to mandate, maybe at mandate on that. So what's driving it? Clearly, payroll job creation has moved down over the last few months, and this bears watching. By many other measures, the labor market has returned to or below 2019 levels, which was a very good, strong labor market, but this is more sort of 2018, 17. So the labor market bears close watching, and we'll be giving it that. But ultimately, we believe, with an appropriate recalibration of our policy, that we can continue to see the economy growing, and that will support the labor market. In the meantime, if you look at the growth in economic activity data, retail sales data that we just got, second quarter GDP, all of this indicates an economy that is still growing at a solid pace. So that should also support the labor market over time. So, but again, it bears watching, and we're watching.
And just on the point about starting to see rising layoffs, if that were to happen, wouldn't the committee already be too late in terms of avoiding a recession?
So our plan, of course, has been to begin to recalibrate. And as you know, we're not seeing rising claims. We're not seeing rising layoffs. We're not seeing that, and we're not hearing that from companies that that's something that's getting ready to happen. So we're not waiting for that, because there is thinking that the time to support the labor market is when it's strong, and not when you begin to see the layoffs. There's some lore on that. So that's the situation we're in. We have, in fact, begun the cutting cycle now, and we'll be watching, and that'll be one of the factors that we consider. Of course, we're going to look at the totality of the data as we make these decisions meeting by meeting.
Michael McKee.
Michael McKee with Bloomberg TV and Radio. To follow up on that, what would constitute for you and the committee a deterioration in the labor market? You're pricing in basically by the end of next year 200 basis points of cuts just to maintain a higher unemployment rate. Would you be moving to a more preemptive monetary policy style rather than, as you did with inflation, waiting until the data gave you a signal?
No, we're going to be watching all of the data, right? So if, as I mentioned in my remarks, if the labor market were to slow unexpectedly, then we have the ability to react to that by cutting faster. We're also going to be looking at our other mandate, though. We have greater confidence now that inflation is moving down to 2%, but at the same time, our plan is that we will be at 2%, over time. So. And policy, we think, is still restrictive, so that should still be happening.
I'm just curious as to how sensitive you'll be to the labor market, since you forecast we are going to see higher unemployment, and it is going to take a significant amount of monetary easing to just maintain it.
So You know, what I would say is we don't think we need to see further loosening in labor market conditions to get inflation down to 2%. But we have a dual mandate, and I think you can take this whole action as take a step back. What have we been trying to achieve? We're trying to achieve a situation where we restore price stability without the kind of painful increase in unemployment that has come sometimes with disinflation. That's what we're trying to do. And I think you can take today's action as a sign of our strong commitment to achieve that goal.
Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. You're describing this view that you don't think you're behind when it comes to the job market. Can you walk us through the specific data points that you found to be most helpful in the discussions at this meeting? You've mentioned a couple, but would you be able to walk us through what that dashboard told you as far as what you know about the job market now?
Sure. So we'll start with unemployment, which is the single most important one probably. You're at 4.2%. That's, you know, I know that's higher than we were used to seeing numbers in the mid and even below mid threes last year. But if you look back over the sweep of the years, that's a very healthy unemployment rate. And anything in the low fours is a good labor market. So that's one thing. Participation is at high levels. It's, you know, we're right adjusted for demographics, for aging. Participation's at pretty high levels. That's a good thing. Wages are still a bit above what would be, their wage increases rather, are still just a bit above where they would be over the very longer term to be consistent with 2% inflation, but they're very much coming down to what that sustainable level is, so we feel good about that. Vacancies over, you know, per unemployed is back to what is still a very strong level. It's not as high as it was. That number reached 2 to 1, 2 vacancies for every unemployed person as measured. It's now below around 1, but that's still a very good number, I would say. You know, quits have come back down to normal levels. I mean, I could go on and on. There are many employment indicators. What do they say? They say this is still a solid labor market. The question isn't the level. The question is that there has been change particularly over the last few months. And, you know, so what we say is as the risks, the upside risks to inflation have really come down, the downside risks to employment have increased. And because we have been patient and held our fire on cutting while inflation has come down, I think we're now in a very good position to manage the risks to both of our goals.
And what do you expect to learn between now and November that will help inform the scale of the cut at the next meeting?
You know, more data, the usual. Don't look for anything else. We'll see another labor report. We'll see another jobs report. I think we get a second jobs report on the day of the meeting, I think. No, on the Friday before the meeting. And inflation data. We'll get all this data. We'll be watching. You know, it's always a question of look at the incoming data and ask what are the implications of that data for the evolving outlook and the balance of risks, and then go through our process and think what's the right thing to do. Is policy where we want it to be to foster the achievement of our goals over time? So that's what it is, and that's what we'll be doing.
Neil.
Thanks. Hi, Chair Powell. Neil Irwin with Axios. We've only been running a little above 100,000 jobs a month on payroll the last 3 months. Do you view that level of job creation as worrying or alarming, or would you be content if we were to kind of stick at that level? And relatedly, you know, one of the welcome trends of the last couple of years has been labor market steam coming out through job openings falling rather than job losses. Do you think that trend has further to run, or do you see risk that further labor market cooling will have to come through job losses?
So on the job creation, it depends on the inflows, right? So if you're having millions of people come into the labor force, and you're creating 100,000 jobs, you're going to see unemployment go up. So it really depends on what's the trend underlying the volatility of people coming into the country. We understand there's been quite an influx across the borders, and that has actually been one of the things that's allowed unemployment rate to rise. And the other thing is just the slower hiring rate, which is something we also watch carefully. So it does depend on what's happening on the supply side. And on the beverage curve question, yes. So we all felt on the committee, not all, but I think everyone on the committee felt that job openings were so elevated that they could fall a long way before you hit the part of the curve where job openings turned into higher unemployment, job loss. And yes, I mean, I think we are, it's hard to know that you can't know these things with great precision, but certainly it appears that we're very close to that point, if not at it, so that further declines in job openings will translate more directly into unemployment. But it's been a great ride down. I mean, we've seen a lot of tightness come out of the labor market in that form without it resulting in lower employment.
Thanks, Chair Powell. Edward Lawrence, Fox Business. So we've heard some speculation that you may be going with the federal funds rate to 3.5, maybe under 4%. And there's basically an entire generation that has experienced zero or near zero federal funds rate. Now, some think we're heading in that direction again. What's the likelihood that cheap money is now the norm?
So this is a question, you mean after we get through all of this? It's just a great question that we can only speculate about. Intuitively, many people anyway would say we're probably not going back to that era where there were trillions of dollars of sovereign bonds trading at negative rates, long-term bonds trading at negative rates. And it looked like the neutral rate might even be negative. So there was people were issuing debt at negative rates. It seems that's so far away now. My own sense is that we're not going back to that. But honestly, we're going to find out. But it feels to me and that the neutral rate is probably significantly higher than it was back then. How high is it? I just don't think we know. Again, we only know it by its works.
And one more. How do you respond to the criticism that will likely come that a deeper rate cut now before the election has some political motivations?
Yeah, so this is my fourth presidential election at the Fed, and it's always the same. We're always going into this meeting in particular and asking what's the right thing to do for the people we serve, and we do that, and we make a decision as a group, and then we announce it, and that's always what it is. It's never about anything else. Nothing else is discussed, and I would also point out that the things that we do really affect economic conditions for the most part with a lag. So nonetheless, this is what we do. Our job is to support the economy on behalf of the American people. And if we get it right, this will benefit the American people significantly. So this really concentrates the mind. And it's something we all take very, very seriously. We don't put up any other filters. I think if you start doing that, I don't know where you stop. And so we just don't do that.
Jolene.
Thank you, Chair Powell. I'm Jolene Kent with CBS News. My first question is, very simply, what message are you trying to send American consumers, the American people, with this unusually large rate cut?
I would just say that, the U.S. economy is in a good place, and our decision today is designed to keep it there. More specifically, the economy is growing at a solid pace. Inflation is coming down closer to our 2% objective over time. And the labor market is still in solid shape. So our intention is really to maintain the strength that we currently see in the U.S. economy. And we'll do that by returning rates from their high level, which has really been, the purpose of which has been to get inflation under control. We're going to move those down over time to a more normal level over time.
Just a quick follow-up to that. Listening to you talk about inflation moving meaningfully down to 2%, is the Federal Reserve effectively declaring a decisive victory over inflation and rising prices?
No, we're not. So inflation, what we say is we want inflation, the goal is to have inflation move down to 2% on a sustainable basis. And, we're not really, we're close, but we're not really at 2%. And I think we're going to want to see it be, around 2% and close to 2% for some time. But we're certainly not we're not saying mission accomplished or anything like that. But I have to say, though, we're encouraged by the progress that we have made.
Katerina.
Hi, Hi, Katerina Saraiva with Bloomberg News. I just would love to know kind of how the committee is thinking about the persistence we've seen in housing inflation. Do you think you can return to 2% with housing inflation where it is? Yeah.
So housing inflation is the one piece that is kind of dragging a bit, if I can say. We know that market rents are doing what we would want them to do, which is to be moving up at relatively low levels, but they're not rolling over. The leases that are rolling over are not coming down as much, and OER is coming in high. So, it's been slower than we expected. I think we now understand that it's going to take some time for those lower market rents to get into this, but, the direction of travel is clear, and as long as market rents remain, relatively low inflation over time, that will show up. Just the time it's taking now, several years rather than just 1 or 2 cycles of annual lease renewals. So that's, I think we understand that now, but I don't think the outcome is in doubt. Again, as long as market rents remain under control, the outcome is not in doubt. So I would say it's the rest of the portfolio, or of the elements that go into core PCE inflation have behaved pretty well. They all have some volatility. We will get down to 2% inflation, I believe, and I believe that ultimately we'll get what we need to get out of the housing services piece too.
Some of your colleagues have expressed concern that with starting to cut rates, you could reignite demand in housing and see prices go up even more. What's the likelihood of that, and how would you react to that?
So the housing market, it's hard to game that out. The housing market is in part frozen because of lock-in with low rates. People don't want to sell their home, so because they have a very low mortgage, it'd be quite expensive to refinance. As rates come down, people will start to move more, and that's probably beginning to happen already. But remember, when that happens, you've got a seller, but you've also got a new buyer in many cases. So it's not obvious how much additional demand that would make. I mean, the real issue with housing is that we have had and are on track to continue to have not enough housing. And so it's going to be challenging. It's hard to zone lots that are in places where people want to live. It's all of the aspects of housing are more and more difficult. And where are we going to get the supply? And this is not something that the Fed can really fix. But I think as we normalize rates, you'll see the housing market normalize. And I mean, ultimately, by getting inflation broadly down and getting those rates normalized and getting the housing cycle normalized, that's the best thing we can do for householders. And then the supply question will have to be dealt with by the market and also by government.
Victoria.
Hi, Victoria Guida with Politico. Just following up on some of the labor market talk earlier, monetary policy operates with long and variable lags, and I'm wondering how much you see being able to keep the unemployment rate from raising too much comes from the fact that you're starting to act now, and that's going to give people more room to run versus just the labor market is strong. And then also, if I could, following up on Nick's question, do you see today's 50 basis point move as partially a response to the fact that you didn't cut in July, and that sort of gets you to the same place?
So you're right about lags, but I would just point to the overall economy. You have an economy that is growing at a solid pace. If you look at forecasters or talk to companies, they'll say that they think 2025 should be a good year too. So there's no sense that the U.S. economy is basically fine. If you talk to market participants, I mean, business people who are actually out there doing business. So I think, I think our move is timely. I do, and as I said, you can see our 50 basis point move as a commitment to make sure that we don't fall behind. So you're really asking about your second question. You're asking about July, and I guess if you ask, if we'd gotten the July report before the meeting, would we have cut? We might well have. We didn't make that decision, but we might well have. I think that's not, that doesn't really answer the question that we ask ourselves, which is let's look, at this meeting, we're looking back to the July employment report, the August employment report, the two CPI reports, one of which came, of course, during blackout, and all of the other things that I mentioned. We're looking at all of those things, and we're asking ourselves, what's the policy stance we need to move to? It's clear that we clearly, literally, everyone on the committee agreed that it's time to move. It's just how fast do you go, and what do you think about the path forward? So this decision we made today had broad support on the committee, and I've discussed the path ahead.
Elizabeth.
Thank you, Chair Powell. Elizabeth Schulze with ABC News. Mortgage rates have already been dropping in anticipation of this announcement. How much more should borrowers expect those rates to drop over the next year?
Very hard for me to say. That's from our standpoint. I can't really speak to mortgage rates. I will say, that'll depend on how the economy evolves. Our intention, though, is we think that our policy was appropriately restrictive. We think that it's time to begin the process of recalibrating it to a level that's more neutral rather than restrictive. We expect that process to take some time, as you can see in the projections that we released today. And if things work out according to that forecast, other rates in the economy will come down as well. However, the rate at which those things happen will really depend on how the economy performs. We can't look a year ahead and know what the economy is going to be doing.
What's your message to households who are frustrated that home prices have still stayed so high as rates have been high? What do you say to those households?
Well, what I can say to the public is that we had a burst of inflation. Many other countries around the world had a similar burst of inflation, and when that happens, part of the answer is that we raise interest rates in order to cool the economy off, in order to reduce inflationary pressures. It's not something that people experience as pleasant, but at the end, what you get is low inflation restored, price stability restored. And a good definition of price stability is that people in their daily decisions, they're not thinking about inflation anymore. That's where everyone wants to be, is back to what's inflation. We just keep it low, keep it stable. We're restoring that. So what we're going through now really, it restores, it will benefit people over a long period of time. Price stability benefits everybody over a long period of time just by virtue of the fact that they don't have to deal with inflation. So that's what's been going on. And I think we've made real progress. We don't tell people how to think about the economy, of course. And of course, people are experiencing high prices as opposed to high inflation. And we understand that's painful.
Greg.
Hi, Chair Powell. Greg Robb from MarketWatch.com. I was wondering if you could go through, you said just at the beginning that coming into the blackout, there was like an open thought of 25 or 50. The Fed could move either 25 or 50. I would sort of argue that when we had those two last speeches by Governor Waller and New York Fed President John Williams, that they were sort of saying that maybe a gradual approach was going to win the day. I mean, I sort of want to ask a 7-part question about this, but I mean, would you have cut rates by 50 basis points if the market had been pricing in like low odds of a 50-point move like they were last Wednesday? After the CPI number came out, it was a really small probability of a 50-point cut. Does that play in your consideration at all? Just talk a little bit about that. Thank you.
We're always going to try to do what we think is the right thing for the economy at that time. That's what we'll do. And that's what we did today.
Simon.
Thank you, Chair Powell. Simon Rabinovich with The Economist. You've mentioned how closely you're watching the labor market, but you also noted that payroll numbers have been a little bit less reliable lately because of the big downward revisions. Does that put your focus overwhelmingly on the unemployment rate? And given the SEP projection of 4.4 basically being the peak in the cycle, would going above that be the kind of thing that would trigger another 50 basis point cut?
So we will continue to look at that broad array of labor market data, including the payroll numbers. We're not discarding those. I mean, we'll certainly look at those, but we will mentally tend to adjust them based on the QCEW adjustment, which you referred to. There isn't a bright line. It will be, the unemployment rate's very important, of course, but there isn't a single statistic or a single bright line over which that might move that would dictate one thing or another. We'll look at each meeting, we'll look at all the data on inflation, economic activity, and the labor market, and we'll make decisions about is our policy stance where it needs to be to foster over the medium term our mandate goals. Yeah, so I can't say we have a bright line in mind.
Matt Egan?
Thanks, Chair Powell. Matt Egan from CNN. I know that you discussed earlier how the Fed does whatever the right thing is and nothing else factors in. But in general, can you talk about whether or not you believe a sitting U.S. president should have a say in Fed decisions on interest rates? Because that's something that former President Trump, who obviously appointed you, has previously suggested. And I know the Fed is designed to be independent, but why? Can you tell the public why you view that so important?
Sure. So countries that are democracies around the world, countries that are sort of like the United States, all have what are called independent central banks. And the reason is that people have found over time that insulating the central bank from direct control by political authorities avoids making monetary policy in a way that favors maybe people who are in office as opposed to people who are not in office. So that's the idea, is that, and I think the data are clear that countries that have independent central banks, they get lower inflation. And so we do our work to serve all Americans. We're not serving any politician, any political figure, any cause, any issue, nothing. It's just maximum employment and price stability on behalf of all Americans. And that's how the other central banks are set up too. It's a good institutional arrangement, which has been good for the public. And I hope and strongly believe that it will, continue.
Kyle.
Kyle Campbell for American Banker. Thanks for taking the questions, Chair Powell. A couple regulatory developments in the past week that I want to ask you about. First, last week, Vice Chair for Supervision, Michael Barr, outlined his views for the changes to the Basel III Endgame. I'm wondering if you are in alignment with him on what those changes should be, if those have support on the board in a broad way that you're looking for, and if you think the other agencies are also fully on board with that approach. And then yesterday, other banking regulators.
You know what? Hold the second question.
Okay, sure.
We'll give you the second question. So the answer to your question is that, yes, those changes were negotiated between the agencies with my support and with my involvement, with the idea that we were going to repropose the changes that Vice Chair Barr talked about, and then take comment on them. So yes, that is, that's happening with my support.
Okay. Is there a date for that?
That's not a final proposal, though. You understand? We're putting them out for comment. We're going to take comment and make appropriate changes. We don't have a calendar date for that. And as for the other agencies, the idea is that we're all moving together. We're not moving separately. So that I don't know exactly where that is, but the idea is that we will move as a group to put this again out for comment, and then it'll come. The comments will come back 60 days later, and we'll dive into them, and we'll try to bring this to a conclusion sometime in the first half of next year.
Right. And then yesterday there were merger reform finalizations from the other bank regulators. Well, what does the Fed have to do to align itself on merger?
I would bounce that question to Vice Chair Barr. It's a good question, but I don't have that today. Thanks.
Okay, we'll go to Jennifer for the last question.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said earlier that the decision today reflects with appropriate recalibration strength in the labor market that can be maintained in the context of moderate growth. even though the policy statement says you view the risks to inflation and job growth as roughly balanced. Given what you've said, though, today, I'm curious, are you more worried about the job market and growth than inflation? Are they not roughly balanced?
No, I think, and we think they are now roughly balanced. So if you go back for a long time, the risks were on inflation. We had a historically tight labor market, historically tight. There was a severe labor shortage. So very hot labor market, and we had inflation way above target. So, that said to us, concentrate on inflation, and we did for a while, and we kept at that. The stance that we put in place 14 months ago was a stance that was focused on bringing down inflation. Part of bringing down inflation, though, is cooling off the economy and a little bit cooling off the labor market. You now have a cooler labor market in part because of our activities. So what that tells you is it's time to change our stance. So we did that. The sense of the change in the stance is that we're recalibrating our policy over time to a stance that will be more neutral. And today I think we made a good, strong start on that. I think it was the right decision, and I think it should send a signal that that we're committed to coming up with a good outcome here.
Is the economy more vulnerable to a shock now that could tip it into recession?
I don't think so. I don't. As I look, well, let me look at it this way. I don't see anything in the economy right now that suggests that the likelihood of a recession, of a downturn, is elevated. Okay, I don't see that. You see growth at a solid rate. You see inflation coming down, and you see a labor market that's still at very solid levels. So I don't really see that. No, thank you.
Thank you.
All right, guys, so that is the end of this meeting. If we pull up all the markets here, again, we're pretty flat. Honestly, for the biggest event of the year so far, markets are sideways and neutral. What do you guys think this means? Again, 50 basis point cut. I see a lot of questions. We're going to do our best to answer them. One of the things that people have to understand, I see a lot of political bias. And again, I'm very neutral politically, but during election years, one side is going to make you think it's the worst it could ever possibly be, right? And then you'll see that repeated everywhere. You might see people that are saying the same thing. A lot of it is influenced by politics. And again, I'm neutral politically. Whichever side doesn't have power during election years, they're going to make you think it's the worst it could ever be, right? And whichever side doesn't have power, whichever side does have power is going to make you think it's the greatest it could ever be, right? Both of those things are not true. Neither one of those are accurate. But the truth is somewhere in the middle, and I just see so many people get influenced by this sentiment that they just kind of regurgitate what they hear the news say, None of that matters. What we got right now is we got to look at economic data. 3% unemployment. 4.5% or less unemployment. It's currently at 4.2%. GDP's at 3%, although we don't know how accurate those numbers are going to be. The last payroll numbers were not good, right? The last payroll numbers were not good, but the last 6 months have been okay. All right. So again, the real risks to the economy currently are inflation, certainly. Like inflation's a problem. A lot of people the reason inflation's a problem is because while unemployment might be low, people are having to work multiple jobs just to be able to afford stuff. Right. And so the number one priority should be inflation. And what Powell's probably going to do, again, I'm not even saying I agree with this. I think we should have a less dovish monetary policy. I think we should be more restrictive personally. But again, that's my own selfish bias out of it. I know some people want to buy homes. Other people want to do all this other stuff. And so I get people wanting a low interest rate environment, but real estate has gone up 70% in 5 years. 70% here in the U.S. That's a crazy amount. It's not sustainable. Nobody can sustain that. And so while you might be benefiting from, wanting a low interest rate environment and all that stuff, neither one of the situations we're in are necessarily good or bad. It depends on what happens. It depends on what inflation data looks like. And again, if you want to check out my sponsor, just to pivot into the sponsor, again, check out TopStepX. TopStepX, one of the best edges in funding. You can kind of see me trading a little bit here in this funded account. Again, they give you a demo on TopStep. They test your skill. Most day traders lose. If you put up $5K trying to day trade, you're probably going to lose that $5K. Doesn't matter who you follow, what your guru says. Almost all day traders lose money. And so if you put up $5,000, you're probably going to lose it. You're not going to be some savant, guru, prodigy day trader like you think you are. You're probably just going to lose money, right? And instead of losing thousands in the beginning, try a funded account program. Top Step's one of the most legit in the world. They give you a demo, test your skill with that demo. The base one's $50K. They give you a $50K demo. If you can make $3K without losing $2K, a 2 to 3 ratio, reasonable, they fund you $50K, 90% split, and they've paid out over $40 million. If you fail, you only lose $49, right? And most people are going to fail because most day traders lose. It doesn't matter where they day trade. Most day traders are going to lose. And so it's a lot cheaper to lose there than anywhere else. It's a great way to learn it. If you really want to learn, day trading can be powerful, but it takes years to learn. You're going to lose most of that time learning, and that's just the truth. Any experienced day trader will tell you that. And again, I day trade. I'm not even claiming to be good. Coming from one of the top 3 worst day traders of all time. Again, I'll put this link up if you want to help support your boy here in this channel. They are a sponsor of mine. They pay me money. I am biased because of it, because they pay me money. If they paid you money, you'd be biased too. And so remember, guys, one of the top 3 worst traders of all time ever in the world. Don't copy me. I'm not an investment professional. I'm not liable if you lose money. If you do, it ain't my fault, is what I'm saying here. Okay? Because it's on you. I'm top 3 worst trader of all time. And so good luck. I do trade off stream. You're not going to see all my trades. I'm not going to show you all of my trades. I'm not even claiming to be good. Understand CFTC 4.41, hypothetical or simulated performance have limitations. We're not liable for it. With that said, though, check it out. Top Step X, 0 commissions on their platform. You can use micro contracts, trade small, 0 commissions. It's a powerful thing. Check it out. Anyways, the gold stock or the gold chart has gone up really big on the initial announcement and then downtrended since then. The SPY is basically completely flat. Completely flat. You know, remember what I've been saying for the last few weeks, chat. I've been telling you markets are flat. You know, I was going to bet on CHOP. You know, so again, the problem here is lenders are convincing, and again, I get it, man. Like people want, like here's the real problem. Inflation is the overarching problem of the country right now. Even right now, even with 3%, and 3% does not mean it's going down. It means it's slowing down. Prices are still increasing, and they don't actually go down unless we actually hit a recession. That's the only time in history where prices actually go down. If you look at a CPI inflation graph, we show this chart all the time. Every day we show this chart. Why do we show this chart? Because there's only been one real time in the last 25 years where prices have actually gone down on average. And again, that was the 2008 mortgage disaster right there. Okay, outside of that scenario, prices don't go down. They just slow it. They slow down, you know. And so we can slow down from the 10% inflation top right here, but it doesn't mean it doesn't mean you're going to be spending less at the store. And that's the thing to understand. And again, it affects everybody. You know, you want to know why other people are unhappy? Prices have gone up so much, and as prices rise, expenses rise. As expenses rise, landlords raise rent on people. They're raising your rent because expenses have gone up for them as well, right? And that is causing people to be stuck in super high rent environments. Rent's up a lot. Mortgage rates are high, so people can't afford things. And so people are struggling right now. But again, it's not purely because we have a high interest rate environment. A low interest rate environment will make inflation worse, not better. And that's the thing you have to understand. At the same time, though, again, I understand people want affordable housing. I get it. But it's not as simple as a solution as people think. It's not like we can just maintain a low interest rate environment and potentially spike inflation and everything's going to be fine. Again, prices are going to go up, not down. It's a tricky thing. It's nuanced, as I always say. And again, just understand all of it with that understanding is that it's nuanced. It's not as easy fix. You know, one of the big questions here during this Fed meeting was, why do they try so hard to make sure that the Federal Reserve and any political body are independent of each other? And it's very obvious why. Why would they be independent? Why would you make them independent? Why would you want them independent to each other? The reason you want that is because if they weren't, whichever side was in power would just constantly stimulate the economy. They would constantly print money. They would constantly lower interest rates because it makes them look good. You know, what is politicians' favorite thing to do? They say, look at the economy. Look how great I am. You know, and if we had constant low interest rate environments, while it make whoever look good, inflation's going up for everybody in those situations. And so, you know, anyways. Yeah. Thanks, John, for the data. Hey, all good, man. Top 3 worst trader. Definitely top 3 worstest traders in the world right now. How do you see the market 6 months out? I have no freaking idea what the market's going to do 6 months out, dude. Are you really disagreeing with me saying inflation started after 1913? Maybe you're talking to somebody else. I don't know. Again, the reality of it is what Powell said, which is that we don't know. It depends. Like, okay, here's the thing, right? Right now, the Fed's plan is to do this. All right, so they are going to do 50 today, 50 basis points today. Next 6-week period, they're going to do 25. Sorry, worst 2 ever. Top 3 worst ever 2s in the world. And then the next meeting after that in December, they're going to do another 25. Right, that's their plan. So what does that mean? Okay, and again, it doesn't mean this is going to happen. You know, somebody was like, hey, they said 25 basis point weeks ago. Now they're saying 50. These are subject to change. You know, we have to read the Fed Reserve's decisions. It's variance heavy. Anything could change these. Again, the only accurate one is if you look at it 30 minutes before the meeting. That's probably what we're going to get. If you looked at the CME watch tool 30 minutes before today, you knew we were going to do 50. But again, the Fed's plan right now is to do 25 or 50 today, 25 next meeting, 25 in December. And that'll drop interest rates, short-term federal funds rate, by a full percentage point by the end of the year. By the end of 2024, we're going to drop interest rates. The Federal Reserve federal funds rate. And again, this takes time to trickle into everything else. Sometimes we'll have some sympathy. So sometimes the Fed will be like, yo, we're cutting rates 50 basis points, and immediately you'll see mortgage impacts. And that's probably already happening. I've heard that's happening now. Wait, the NBA 30-year mortgage rate came out this morning. Let's see what it came out at. Hold on, let me check that real quick. I know it came out this morning. We had other stuff we were doing. NBA 30-year mortgage rate went down week to week from 6.3% to 6.15%. And so mortgages are slowly dropping, but we'll see what that happens. And even if mortgage rates go down, house prices are, you know, we don't know what they're going to do either. So, yeah, 100%, Kevin. If you have no debts, including your mortgage, you do not have to worry about this. Yeah, 100%. I don't, you know. Again, that's why I tell people I'm okay with having a restrictive monetary policy. People don't understand. I'm okay with keeping rates high because that's going to do the most ultimately to combat inflation versus a low interest rate environment. And again, one thing that I did like to hear from this meeting is that the Federal Reserve is going to continue tightening their balance sheet. You know, I don't want them to pivot away from quantitative tightening. Quantitative tightening is the Federal Reserve expands their balance sheet in periods of QE, money printing. They create money. They use it to buy bonds. They inject they fill up their balance sheet with stuff. We've in the last few years to combat inflation, along with rate hikes and pausing rates, the Federal Reserve has done what's called passive quantitative tightening, which means that they are they're letting their current holdings, like their current balance sheet holdings, mature and run off, and they're reducing their balance sheet. And this will ultimately help maintain a little bit more restrictive monetary policy. And I did like to hear that because I think one of the reasons we got inflation in 2020, you know, the Fed will be dovish, pull interest rates down, inject liquidity through money printing into the economy if they feel like the economy's breaking. So we got one in 2008. We got one in 2020 where they thought the economy was breaking. They did QE, which is, again, expanding their balance sheet, money printing, and they did rate cuts, right? And that contributed to inflation. Inflation spiked up to 10%, and a lot of it was stimulus check related as well, to be honest. But now they're still maintaining their quantitative tightening stance, which is good. Okay, I don't want them to do rate cuts and pivot away from QT and go into QE and start printing up more stuff. I don't want that. That's going to make inflation worse as well. And so it was optimistic for them to not do that. I'm not saying it's good. You know, you got some people that are so wrapped up and, you know, biased around politics that me just saying this stuff might just make them so upset. And again, if that's the case, you got to stop, take a step back, breathe a little bit. You'll be okay. I'm very neutral politically. I don't care about any politician. I don't like any of it, you know. Anyways, guys, I'm out of here. Hey, I love you all. Y'all be good. Yeah, Elit, man, you just seem so upset, dude. You seem so upset, dude. I don't even watch the media, brother. You know, I don't even watch the media, dude. You know, like, I'm just talking about, I'm teaching people economics, and you're getting upset in the corner, brother. Good day to you, man. Again, y'all are just weird, you know. I'm not even taking sides here. I'm not even saying one's good or one's bad, right? I think there's pros and cons to either way, either way is pros and cons, right? Hey, I appreciate the love. Thanks so much. Hey, tomorrow we have jobless claims, unemployment coming out. Jobless claims, unemployment filings, week-to-week report. Not the biggest report, but still relevant. 8:30 Eastern Standard Time tomorrow morning. It drops. Currently tomorrow they are expecting. Yeah, for sure. Like, imagine just teaching people basic economics, like what quantitative easing is, what rates mean, and somebody just lashing out because they're talking about inflation in 1913. I genuinely feel bad for people like that. They're so emotional about it. Like, let it out, dude. I'm here. It's okay. Guys, it's all right. I'm here. Just let it out. I'll be your punching bag. It's all right. Top 3 best punching bags in the world right now. But hey, I definitely top 3 worst ever economy teachers in the world. I'll see you guys later. Y'all be good. Hey. 8:30 Eastern Standard Time tomorrow morning. Love you all. Y'all have a great day. I'll see you guys later.